Okay. So if you come to Kupu reporting, what are the standards that are likely to appear in the exam? Okay. So if you come to Kupu reporting, the ISS and the IFRSs that are going to be examined here, the first one is, okay, the common one that they have been examining right now is IS36. Okay, for the past 1 year, they have examined this particular standard and any other standard, IS36, impairment of assets. Okay, if you come to the impairment of assets, what are the things that can be examined? It is not going to be like the impairment that you have done at financial reporting level where they will just give you a simple cash generating unit and they will give you the recoverable amount. No, you will be expected to calculate your own recoverable amount and also calculate your own carrying value and look for whether the asset is impairing or not and how do you share the impairment. So you are going to be looking at impairment of subsidiary here. So they can give you an impairment of subsidiary and we have tried to solve one question. We have solved one question under that. Okay, you'll be given impairment of subsidiary. How do you, it's just like a cash generating unit. So when are they carrying out the impairment on the subsidiary? Look for the net asset of the subsidiary at that date. The net asset of the subsidiary is their physical asset plus the goodwill. So what is the recoverable amount and what is the carrying value? Is there any impairment? You share the impairment like what? A cash generating unit. Is there any physical damage asset? That asset should take its first. Is there any goodwill? Goodwill should take it. Then the remaining one will be shared among the what the likely impaired what assets. So they can examine you on impairment of subsidiary. Another one is they can also ask you a question on impairment of corporate assets, which was the first time that this was examined last sitting in impairment of corporate assets. These are the technical side of these issues. So they can examine you on corporate asset where we have so many divisions or so many subsidiaries, they are sharing only one facility. That facility is called corporate assets because that facility cannot be attributable to any of these divisions. Ghana and Nigeria, Togo are using a facility that is located in South Africa. It is something that all of them are having access to. We can't say that is for Ghana, that is for Nigeria, or that is for Togo. It is called a corporate asset. Okay, mostly it is a research and development center that is being accessed by all the subsidiaries. So we call that one corporate asset. How do we determine impairment of that particular asset? That was examined last sitting, the first time. Okay. They can also give you
guys keep quiet.
They can also give you a question on a normal impairment, normal question, but it will not be normal. Okay, normal question, but it will not be normal. What do I mean by normal question? This is an example of normal impairment question. Okay, so normal impairment question is this. Okay, this is a normal impairment question. Question number 4. Okay, it is normal, but it's not normal. Okay, so they can give you a normal impairment question like this, where you have to calculate your recoverable amount like normal. They can give you this one. Okay, your corporate reporting question is going to be saying that, okay, this is a corporate reporting question. They are not differentiating between corporate reporting and financial reporting, especially in terms of the standards. So IS36 can also be there. Then we come to the IFRS 6, which is also one of the common standards now that they have been examining. Okay, and this one, you can have sales and leaseback. Okay, sales and leaseback, which haven't been examined in corporate reporting, sales and leaseback. We have looked at that, where the lessor will sell the asset to the customer, and now we agree to lease the asset back. So we are the owner, now we are going to be the lessee. The buyer will now be the lessor. Okay, you have to ask yourself, does this particular transaction constitute what? A sale? A sale means, do we transfer possession, risks, and ownership associated with the asset to the buyer? If that is the case, then we have to de-recognize the asset from our books and now recognize the profit. How do we recognize the profit? The profit will be recognized to the extent of the portion of the asset that has been transferred to the lessor who is the buyer. So we determine the right of use using the present value of the minimum lease payment divided by the fair value of the asset multiplied by the carrying value. We have done that under leases. So sales and lease back, they can also examine you on that. And we also have the reassessment of lease. Okay, that will be the area that if they want to examine you, reassessment of lease liability. So the lease liability, what will happen? We are saying that we are going to be leasing the facility for 10 years. Now we have decided to what? Make it what? 8 years. It means that the lease period has changed. So the liability also has to be recalculated. The discount factor has also changed. We have to now calculate our lease liability using the same factor. The amount that we are paying, the renter has changed. We now have to re-estimate our what? Our lease liability. That's what we call the reassessment of lease liability. You can also be seeing a lessor accounting. Okay, they can also examine you on the lessor accounting. So if you count to leases, these are the at least the normal one there, forget about them. That lessee accounting, the normal lessee accounting, forget about it. Count to sales and lease by reassessment of lease liability, lessor accounting. Then what are we going to be saying? We are going to be having the earnings per share. Okay, the earnings per share, they can ask you to calculate earnings per share for just a normal company, but they can also ask you to calculate the earnings per share for a parent company. So the normal company is the profit attributable to the ordinary shareholders. If you come to the parent company, it is a profit attributable to the parent company and the ordinary shares of the parent company. So they can be giving you questions where there will be a full market value issue, there will be a bonus issue followed by a right issue, or they can give you a question on diluted earnings per share. So you have to, it is going to be complicated, not the normal earnings per share question. It's going to be complicated. So we also look at that and see. So they can ask you a question on basic earnings per share, which will be an advanced one, or they can ask you a question on diluted earnings per share, which will also be an advanced one. Okay. What standard again? Okay, from this, they can also ask you a question on IFRS 5. Okay, non-current asset held for sale and discontinued operation. And this, if they want to give you a question, it will always be on disposable group. Disposable group, how do you, it will always be the disposable group and the impairment issues. Okay, or they can give you a change of plan. Okay, a change of plan is where we don't want to sell the asset again. We have to reclassify the assets. So how do we go about it? The calculation or the accounting treatment is done as if the classification was not done in the first place. So we look at that and look at what we can do about that. So we also look at the IAS 19, employees benefits. So the employees benefit is just a normal question that will be given to you. The question can be given to you based on maybe normal question, or they can examine you on issues of settlement. Okay, settlement is a situation where we are paying part of the obligation to those people. There might be a settlement loss or settlement gain, or there can be an issue of what we call settlement. So we are now reducing the number of employees purposely to reduce our the pension obligation. Okay, so we are doing restructuring. Why are we doing the restructuring? We are laying some people off with the mindset of reducing our pension obligation. So the reduction in the pension obligation as a result of the restructuring, or as a result of reducing the number of employees, what we call the curtailment. It can be a gain or it can be a loss. And you also have what we call the asset ceiling. Okay, asset ceiling is a situation where your contribution to the scheme is higher than the present obligation. So what will happen? You will be asked to recognize, or they will tell you that the only refund that you can get from the investment is maybe you are having an asset surplus of 200 million, and they will tell you that, okay, the maximum refund that you can get from the fund is 150. It means that this has been set at the highest amount of 150. So you have to now recognize the 150 as what we call the assets. That is what we call the asset ceiling. There will be a minimum amount that you can recoup from the investments. So there can be an issue of asset ceiling. Okay, and we have solved questions on that also. You can also be giving question on IFRS 2, share-based payments. Okay, the share-based payments, IFRS 2, which will be a share-based payment. The question can be on equity settled. The question can be on cash settled, or the question can be on a hybrid one. So where there are going to be equity component and what? The cash component or the debt component. Or a question can be given to you based on non-market conditions, where they will be saying that the share will be vested or the options will be vested if the company achieves earnings per share over this. Whenever you want to look at the vesting period, you have to take into consideration the non-market conditions. But whenever they are saying that the share price increased by this amount, share price increase in the share price, a market condition, which is assumed to be taken into consideration at the time that we are determining the fair value at the grant date. So if the question is talking about increase in share price, ignore. That it is about earnings, increase in earnings, increase in revenue. Maybe the employees are going to be, their pay are going to be rising amount. Those are non-market conditions. They are not relating to the share price of the entity. You have to take them into consideration. They can also give you a question on replacing equity settled with a cash settled. There can be a question like that also. Okay, so you also have to pay attention to that. You also have question on IFRS 15. Okay, IFRS 15, we can see we have something that we call incremental costs. Okay, incremental costs. So these are the advanced side of the standard, incremental costs. How do we account for incremental costs? There can also be construction contracts where revenue will be recognized over time and recognized at a point in time. So we come to construction contracts. Construction contract. If you are constructing a building, a structure for somebody, sometimes you see that the contractor will finish some part of the building, people will move in. Okay, so ownership will be what? Will be given to the person in stages. So you also recognize the revenue in stages. That's the revenue recognized over time. How do we go about that? There can also be a question on that. Question can be on variable items, where they are going to be saying that if you're able to complete the work, we'll give you a bonus of this. If you are not able to complete the work within time, you are going to be paying penalties of this. Also, we can sell to you at a finance component. We sell and give the goods to you, and you pay at a future date. How do we go about that? We also have to you also have to be able to do something about that. There can also be a situation where borrowing costs will come into the IFRS 15. How do we, or when will borrowing costs come in? Okay, you are doing a construction for somebody and your policy is that the revenue or the goods will be transferred to the person at the point of sale, or revenue should be recognized at a point in time. Point in time means you only recognize revenue when the goods has been transferred to what? To the final customer, or when the person takes ownership of the items. So the person can give you an advance payment that you are going to be using to construct the assets. The asset will not be seen as a qualifying asset, and the money the person giving to you will not be treated as a loan. So you are now financing the construction of the asset through the money that the person is giving to you, and that particular amount of money will be treated as a loan. So you have to now capitalize the interest that you'll be paying on that particular amount every year or every month on the cost of the assets. So borrowing costs can also come in when you are doing the IFRS 15. You can also have IAS 37. Okay, 37, which is provisions. This one, they can examine you on the reassessment of decommissioning costs. Okay, they have examined this one once, where the decommissioning cost at a point in time, you realize that no, the amount that you are estimating. So we can be estimating that we are going to be spending 200 million at the end of 10 years. After 2 years, you have realized that no, the money should have been 150 million. There's a change in the estimate. How do we account for it? It depends on how you are carrying the assets. If you are carrying the asset at the cost model, how do you go about it? Revaluation model, how do you go about it? We pick a question and also demonstrate that. What again? What are the, we have 36, 16, 33, 5, 19, 2, 15, 37, and what would be the,
Financial instruments.
thank you, financial instruments. Okay. So financial instruments, basically they will be asking you about maybe impairment of financial assets. Okay, impairment of financial assets, and they will also ask you about modification of a loan. We have solved a question on modification of a loan before, which is depending on how significant. We look at the significance of the change. If it is more than 10%, if the change is more than 10%, that is significant. If it's less than 10%, that is not significant. We look at the treatment. So modification of a loan. So you have to also pay attention to that. What again, I'm sure these are the important standards that they can examine on. And
Hello, sir.
yes, yeah.
Please, what about related parties?
Okay. Related parties can also be 38 is also part, just that at this stage I'm trying to forget the standards. Okay. So we also have 38. 38 is also there. So we have the IS 38 intangibles. And the intangibles they can ask you, because ICA is now one to, they can ask you question on players registration and accounting treatments. Okay. And they can, so we also have 24, which is related party. It's one of the areas that they can ask you. This one is not anything. Okay. The related party, who do we call a related party? If the wife of the managing director is a related party, because that particular, the wife can influence the decision of the what? Of the manager. Okay. A subsidiary can also be seen as a related party. An associate can also be seen as a related party. The CEO himself can also be seen as a related party to the entity. Okay, so this has been examined the last time, and they can also give you a question on maybe IFRS 13, which is share fair value measurements, or they can also give you a question on the IFRS 8, which is segmental analysis, but these are minor standards, or they can also give you questions on IFRS 11, joint arrangement and some issues. Okay, so basically I'm sure these are the all things being equal. Yeah, these are the major standards that you can examine on. But please, 36 is very important, 16 is very important, 33 is very important, the 5 is very important, 19 is very important, 2 is very important, the 15 is very important, 37 is very important, 38 important, 24 they are minor issues that they will be given to you for maybe 4 marks or 5 marks. There can also be a 21. Okay, IS 21 is one of the standards that they like examining in corporate reporting. Effects of what? Foreign exchange transactions, and also they can examine you on IS 12, income tax, and this will be in a theory form. Okay, so please let's try and see if we can get an understanding of those
Hello.
yes, please.
Oh, okay. I'm not hearing anything, so I thought it's my internet.
Uh, All right. So those are basically, please, let's try to see if we can get an understanding, but we are going to solve some questions on those ones, and whatever happens, you'll be able to understand the side that IC is now moving to, like they want to be at the international level. So they are also examining the advanced issues on the standards now. So you should also be able to be on top of those standards. What are the technical side of the standards? Like the corporate asset is a technical side of the impairment of assets. Okay, if you come to IFRS now, what is the technical side? That is the impairment of assets. Reassessment of lease liability is also something that is not common. Some of us, we haven't heard about it before. Okay, so let's try to be on top of those issues. Auntie Agnes, question number 1. Auntie Agnes, are you there?
Hello.
Where did you go to?
I was attending to something.
Okay.
Okay. Question 1. Financial statements of Hikmat Limited, HL, for the year ended 31st December 2019 are under preparation. In this respect, following matter is under consideration. On 1st September 2019, HL entered into a contract to develop a software for Doctor Limited for 150 million Ghana cedis. HL ascertained that the promised development of software is a single performance obligation, has satisfied over time. The terms of the contract include a penalty of 14 million Ghana cedis if the development of software is not completed before 29th February 2020. At the inception of the contract, HL determined that the expected cost of completing the contract would be 90 million Ghana cedis, and the software development would be completed before 29th February 2020. Till 31st December 2019, HL incurred costs of 67.5 million Ghana cedis, as the original contract was 75% complete. HL has recognized revenue and profits of 112.5 million Ghana cedis and 45 million Ghana cedis respectively in the draft financial statements. However, HL and DL have amended the contract on 31st December 2019. As a result, the consideration and expected cost increased by 70 million Ghana cedis and 40 million Ghana cedis respectively. The allowable time for completion without penalty is increased by 1 month only. HL now expects that the development of software would not be completed by 31st March 2020. The additional work is not distinct from services and the original contract. No adjustments has been made in HL's financial statement in respect of the amendments in the contract. Required. Discuss how the above transaction should be dealt with in HL's financial statement for the year ended 31st December 2019. Show all calculations wherever possible.
Okay, thank you. All right, so this is a question on IFRS 15, revenue from contract with customers. Okay, so the on 1st September 2019, the company entered into a contract to develop a software for an amount of 150 million. Okay, they have ascertained that the promised development of a software is a single performance obligation satisfied over time. What do we mean by a single performance satisfied over time? Okay, if they say performance is satisfied over time, it means that you are going to be doing you are going to be performing the obligation small at the end of the agreed period. So you are coming to do a work for me. Okay, maybe the work will take 10 days. So you come and do the work small for the work to be done over the 10 days. So you come today and do some part of the work. So you have completed that particular part of the work. The next day, you're also coming to work on another one or do a different thing. You have completed that part also. So the first day, what is the value of the work completed? I'll give you that money. And the cost that you have incurred, you will now determine your profit. So whenever they say performance obligation is satisfied over time, we also recognize the revenue in that particular direction. The revenue will also be recognized over time. Okay. They are saying that the company, the terms of the contract include a penalty of 14 million if the development of software is not completed before 29 February. At the inception of the contract, HR determined that the expected cost of completing the contract will be 90 million and the software development will be completed before 29 February 2020. So they are certain that they are going to be completing the work and the work will be completed at 90. Okay, if the work will be completed at 90 and the value that we are charging for the contract is 150, what will be the profit from the contract?
60.
Okay, the profit from the contract will be 60. Okay, so let's come to the contract price. Okay, the contract price is 150 and the expected cost of the total amount that we are going to be incurring to complete the contract is expected cost is 90. Okay, so we are having a profit of 60. Okay. For you to recognize the 60, for you to recognize all the 60 as profit, it means that you have to complete the work at 90. You have to complete all the work at a cost of 90. So we can directly say that 90 is equal to 60. Okay, 90, you have to incur a cost of 90 to get a profit of 60. Okay, till 31 December 2019, HR incurred cost of what? 67.5 million. Okay, 67.5 million as the original contract was 75 complete. We are going to look at how they got the 75 amount that is complete. Okay, if 90 is equal to 60, 67.5 will be equal to how much?
That'll be 45.
Okay, so 67.5 cost will give us a profit of 45. Check whether that profit is 45.
Yeah, 45.
Okay, so we are coming to look at this. Okay, if we ended up incurring a cost of 90% on the contract, it means that the work is 100% done, isn't it?
Yes.
Okay, but if we now incur 67.5, what percentage of the work is done? If you incur a cost of 90, it means that the work is done. Okay, but now we incur the cost of 67.5. What percentage of the work that is done?
75%.
Okay, so if you come to a situation where a performance is satisfied over time, we use what we call the input method and we use what we call the output method. Okay, the output method. These are used to determine the percentage of completion. If you are using the percentage, if you're using the input method, what we do is that we use cost. We use cost to determine the percentage of the work that is completed. So we use cost to determine that. What is the expected cost to complete the contract? What is the cost that we have incurred? What percentage of the cost is incurred? That is the portion of the work that is completed. So we measure the performance in relation to cost. But if you're using output method, we use what we call the revenue, or the revenue that we are going to be realizing from the work that is being done. So we use the revenue. Okay. So the question will give you that, okay, the work satisfied by a professional. So that is the revenue that they can give to you. So out of the 150, the work satisfied is this amount. So what percentage of the revenue that you are receiving from the work satisfied? We use that to determine the completion of the work. Okay. So now the company is having a contract of a contract that worth what? 150. And the total cost that we are going to be incurring is 60. Okay. All things being equal, we have incurred 67.5. We have incurred 67.5 of the cost, means that 75% of the work is done. Okay, if 75% of work is done, what should be the portion of the revenue that we should recognize? So the portion of the revenue that will be recognized will be 75% of the total revenue. Okay, that will give us 150. How much are we getting?
One, 2.5.
112.5. Okay. So we also incur 75% of the cost, which will still be the actual cost incurred of 67.5. Okay. They are having 45. This is what the entity has done. This is what the entity has recognized in their books. Okay, this is what they have recognized in their books. They haven't received any amount of money from the people. They haven't said anything about that. So sometimes they will give you the amount received. Then we find what we call contract asset. Okay. They say we should discuss. Okay. The initial contract was for a certain period, which is from September to the ending period should be 29 February 2020. Okay. All things being equal, this is just a contract. So the revenue should be recognized based on the completion of the contract. So based on the original contract, the entity has incurred a cost of 67.5. That means that the entity has completed what? 75% of the work. So 75% of the revenue should be recognized to reflect the portion of the work that is done, and 75% of the cost should also be recognized. And that is what they have done. What happened? The contract has been modified. Okay, the contract has been what? Modified. However, HR and DL have amended the contract on 31 December 2019. As a result, the consideration expected cost increased by 70 million and 40 million. So we have amended the contract. The question now is, the amendment, is it relating to the what? The original contract, or is a different contract that we are taking? If it is a different contract that we are taking, that particular contract will also be accounted for as a different what? Contract. But let's be ready and see whether it is the work that we are going to be performing is the same as what? The new modification that is coming. Is the modification relating to existing contracts, or is a different contract? If it is a different contract, that particular contract will also be treated as a separate contract. But if it is no different, then we have to now institute, or we have to now include a modification into the what? Original contract. Okay. The allowable time for completion without penalty is increased by 1 month only. HR now expect that development of the software will not be completed by 31 March 2020. The additional work is no distinct from service under the original contract. The modification is relating to a different work that we are going to be doing.
No, it's the same contract.
Okay. So right now, what will now be the amount under the contract? What will now be the contract price? What will now be
150 plus 70.
Okay.
220.
The new contract price. So we come to the modification, the new contract price. The work completed, will you be 75? Will it still be 75? The portion of the work.
Yes, as at the date of the verification, 75.
No, but if you now take the original agreement in addition to the new agreement now, will you complete 75% of the work?
Plus
No.
40.
No.
It will be different. The completion will be different now, isn't it?
Yes.
Okay.
Yes.
So we have to calculate the completion again. Okay. Because if you are now adding a new work to it, the work will now expand. So what is the portion of the work that you are going to be completing? It will not be 75 again. So let's count to the contract price here.
51%.
Okay. So the contract price will be 150 multiplied by what? 70. Okay. Then that will give us 220, isn't it? That will be 220. Okay. The allowable time for completion without penalties is increased by 1 month only. However, okay, HL now expect that the development of software will not be completed by 31 March 2020. The additional work is not distinct from this and this one. So are we going to be paying the penalty based on what we are giving now? What we are give based on the information that we are given, is the payment or the penalty possible?
It is likely.
Okay, they are saying that for now, based on the information, they are saying that they are not expected to complete. So it means that they will be paying the penalty, isn't it?
Yes.
Okay. Wherever you have a variable amount, and the inclusion of that particular variable amount into the contract price will not affect the subsequent treatment of that particular amount. That variable amount should be added to the contract price, or that variable potential payment should be subtracted from the variable amount. What am I trying to say? The meaning is that the 14 million will be taken away from the price before these people, they will pay us. Because we are not able to we are not able to, or we will not be able to complete the work. So if we are not able to complete the work, it means that we are going to be paying 14 million of the amount that we are receiving. So the penalty will be taken away from our contract price. It means that the contract price, we have included a penalty as part of the amount. So since we are going to be paying the penalty, that should be subtracted. If it is additional amount that will be given to the entity, that if the entity is able to complete the work before this date, they will be given additional bonus. The question is the entity certain that they are going to be doing this? If that is the case, add the bonus to the contract price. Okay, so since we are not going to be completing the work, it means that we are going to be paying the penalty out of the contract price. So subtract the penalty from the contract price. So we bring the penalty here. Penalty from the contract price, that will be 14. What will be the actual contract price?
$206.
Okay. Okay. So let's come to the new cost now. The cost to complete now. So cost of the contract will now be 90 plus what? 40. Is that it?
Yeah, that's it. Now that
Yes,
should be
that's
130.
Yeah.
That will be 130, isn't it?
Yeah.
Okay. But up to today, what is the cost incurred?
$67.5.
Okay, so we now have to find our new percentage. We now have to find our new percentage of completion. So we find the percentage of completion now. So find your new percentage of completion. So that will be 0. Percentage of completion. That will now be, okay, you need to complete the work by incurring 130, but you have incurred 67.5. So what portion of that amount has been completed? So what portion of the work has been completed?
1.9%.
51.9.
Okay. Can you make it 52?
Okay.
Okay. So we have completed 52% of the work. So the revenue that should be recognized on this particular work should be 0.52 multiplied by the contract price net of the penalty, 206. Okay, and your cost of sales should be 0.52 multiplied by the 130, which will still be the same as the 67 point. So what is the revenue amount?
$107.1.
07.2.
Okay, 107.12.
And
And this will be 67 point what? Okay, so what will be the profit?
$39.62.
Okay, 39.
0.6.
Now the cost will still be the same as the cost incurred. Okay, it's because we are doing approximation. So just write your 67.5. Okay. So 39 point what?
62.
Okay. So what we have to do is that, okay, the contract should now be, since the work given to us is not different from what? It's not different from the work that we are already doing. The contract should be, the modification should be added to the existing contract. If that is done, then our contract price will be 220. But since we are not expecting to complete the work before the deadline, it means that we are going to be paying penalty. So the penalty will be paid out of the contract price. So we have to net the contract price against the penalty. The new cost will now be the 70, the 90 that we are having plus the additional cost that we have to incur to complete the work under the modification. That will be 130. But we have already done a work that cost was 67.5. So if the total work is now 130, we have done 67.5. What portion or what percentage of the work that is done? We now re-estimate it and we now readjust our revenue. So revenue supposed to now be adjusted with how much? How much was recognized for the revenue first? The amount,
The first one was 112.5.
but the actual revenue is supposed to be
Actual.
based on the modification.
Okay,
107.
107.12.
So what do we have to do? We have to go and subtract what? How much are we subtracting from revenue?
$5.38.
38.
Okay. So reduce the revenue by 5.38. So you can put your 5.38 in the bracket, how it has been calculated, minus the 10, this one. We don't have any information about contract assets, but we do it as if they have also recognized what we call contract assets. Okay. What do we call contract assets? Okay. Let's come to contract assets. Okay. Let's come here. I'm doing a work for you that have incurred a cost of 50 million. Okay. And on that particular work, I need to get a profit of 10 million. If I want to charge you, how much will I charge you? I've spent a cost of 50 million and I need to get a profit of 10 million on the contract. How much should I charge you? After I'm done with the work, how much should I charge you?
60 million.
Okay, I will charge you 60 million. If you have paid me 40 million, how much are you owing me?
20 million.
20.
Okay, that 20 is what we call the contract asset. Okay, it's an asset that is coming from the contract. So the contract asset is calculated like this. Okay, just the contract asset is calculated as, okay, the contract asset contract asset is calculated as the cost incurred up to date. So I've incurred a cost of 50 million up to date. So the cost incurred up to date, cost incurred up to date. So cost incurred up to date. Okay. Then what will you do? You add the profit on the what? On that one. Then you look at the amount received, the cash received from the person. Okay, the cash received from the person. Then what will happen is that you net this one, and then you have what we call a contract asset. It can also be a liability. Okay, it can be a situation where you are having a loss. That will be treated as an onerous contract. So a contract that you are going to be spending more than that. So you make provision for the excess amount that you'll be spending. That's what we call the onerous contract. But most of the times it will always be a contract asset. So that is an example that I've shown right now. I've incurred a cost of 40 million on the work that I've done for you. I've incurred a cost of 50 million up to date. And I'm supposed to get a profit of what? 10 million. You have paid me 40 million. It means that you are owing me what we call 20 million. That is what we call the contract asset. It is calculated as cost incurred up to date, the profit on the contract. How do we calculate the profit? You can just find this particular profit over here can be calculated as 206 minus 130. So the 206 minus 130 is the total profit, but I've done only 52%. So you multiply 52% on the profit, you can get the same value like doing it like this. Okay. So what if they have recognized contract assets? Let's try that one also. What if they have recognized a contract asset based on the original amount? It will be the cost incurred to date. It will be a cost incurred to date. That will be 67.5 that they have recognized, plus the profit that they have recognized of 45. So that will be the same as the selling price of the work that is done. Okay, they haven't recognized, the question didn't tell us that they have received any amount. So the people are still owing them. So you have a contract asset of this in their statement of financial position under current what? Asset, because this will be paid within 6 months or few months. Okay, this is under the original contract. Okay, let's come to the new contract, the new amount now. Okay, under the modification, we need to find our new contract asset. That will be the cost, see the cost incurred up to date. That will still be 67.5, but our profit on the contract now will be 39.62. So 39.62. What's supposed to be our contract asset?
107.12.
107.12. Okay, 107.12. Okay, so it means that they have a higher amount of contract asset over here. We have to go to the statement of financial position and we do the same figure by the 5.38, which is the same amount that we are reducing from the revenue. Okay, so this is the computation that you have to be doing. They have to reduce their revenue recognized. The revenue has to be recognized now on the new contract, which is including the modification. We have to recognize revenue now based on the what? On the new contract now. We have added additional work to it. So this will now be treated as a new contract. So what is the portion of the work that is completed? We have to re-estimate our what? Our percentage of the work completed. Okay, and yeah, so this is what we are going to be telling them with computations, and the subtraction and the addition that will be coming in is the discussion that they are talking about using your English. Okay, so this is a modification of a construction contract. If the modification is different from our original contract, the modification will be treated as additional contract or a different contract. Okay, if we want to, the software The software, what we have to do is that we are just adding domain name and those things. If you are now saying that we have to add that one, that will also be treated as a different contract, because the first one we are just adding domain name. If you want us to now add pages, website pages, the WhatsApp pages will also be treated as a different contract that we are taking from you, because the work that we are going to be doing is different. But situation where the work that you are doing currently is not different from the work that you are going to be doing, it is just an extension of the existing contract. So that one must be added to the existing contract, then you now account for it. It's not anything. Yeah. So this is all about this one. Any issue before we move on?
So if I get you, the modification is trying to find the contract where I don't know how to put it.
Oh, don't worry, you can put it in
like a sub.
Oh, don't worry.
A sub. Because you started the construction to a certain point.
Yeah.
And then you started another one, but they are together.
It's just an extension. It's just like I've taken it to my farm, and I said that okay, you should weed to some portion. But looking at the work, I said no, you just do all of them. How much are you going to be charging? So you have mentioned the amount. So it means that you are going to be doing that work in addition to this one. They are all going to be the weeding. So it's not a different contract. The work that you're going to be doing are all the same under whatever you are going to be doing again. So you just add it to this one as what? As the contract has been what? The work has been extended. But if you have to, I'm saying that you should go and do weeding. Now I'm not asking you that you should help me with, you are just going to be weeding. Okay, you're not going to be doing anything. But I'm just asking you now to help me harvest maybe cassava over there. You can see that the work that you are going to be doing are going to be two different things. So you tell me that, okay, let me finish with the weeding first before you start harvesting the cassava. These are two different contracts. But if it's just weeding that you are going to be doing, just add it to the existing one as an extension to the existing contract.
Okay, sir.
So I hope you're okay now.
Yes, sir.
All
Yes,
right.
sir.
All right.
Yeah, Ren,
Yes, yeah.
please, if we add the penalty to the cost to complete, will it have the same effect?
Yes, it will have the same effect.
So is it permitted to do it like that, or it is always subtracted from the contract price?
Okay, we have so many, the standards are written by individuals like us. Okay, they are saying that whenever you have a variable element and it is certain that you can get that particular amount of money, you can add it. But we have alternatives. So if you are telling me that if I'm able to weed the farm within 2 hours, you'll give me additional 10 cedis, but I've charged you 100 cedis. So if I'm certain that I'm going to be completing the work before the 2 hours, I can say that I'm going to be taking 110 from you. So I can add a 10 to the 100 I'm charging you. But if I'm not sure, then I have to leave that one and only concentrate on what? On the 100. The same way I can also subtract the 10 from the cost that I'll be incurring on the what? On the weeding. They are all going to be having the same effect. So you can add a penalty to the cost and do the same thing. They are going to be having the same effect because they are all going to be affected by 52%, 52%.
All right, thank you.
Please, can you take it again on the percentage of completion on the under the modification? Probably if you can use ratio and proportion for me.
Okay. We now know that modification, the total cost that we'll be incurring will be the 90 plus the additional 40, isn't it?
Yes.
Okay, but we have done some portion of the work, which costs us what? 67.5, isn't it?
Yes, please.
We know that if we incur a total cost of 130, it means that the work has been completed. Are you okay with that?
Yes, sir.
Okay. But if 130, we have incurred a cost of 130, it means that we have completed the work. So that is 100% completion. But we have incurred only 67.5. So what will be the percentage of completion? So you can do the the multiplication and see. So 130 is equal to 100%. 67.5 will be equal to what? I'm sure you're
Okay.
getting the same thing.
Yes, sir.
Okay.
Thank you.
All right. All right. Okay. I hope we don't have any other issues relating to that. Let's take question number 2, which is a reassessment of lease liability.
Question 2.
Yeah.
On 1st January 2015, Dela Motors Limited acquired a machine on lease through Drain Leasing Company to manufacture components of a new model of vehicle on the following terms. A. Non-cancelable lease period of 7 years. B. The agreement contains an option for DML to extend the lease for further 3 years, in which case the legal title of the machine will be transferred to DML at the end of 10 years. C. Lease installments are payable annually in advance as under: first 7 installments at 80 million Ghana cedis each, 3 installments at 70 million Ghana cedis each for the optional period. DML also incurred initial direct cost of 15 million Ghana cedis for the lease. DML's incremental borrowing rate as 1st January 2015 was 8% per annum. Useful life of the machine is 12 years. On commencement of the lease, DML was reasonably certain that the option to extend the term will be exercised. However, after the first year of production of the new model, DML assessed that the model is not popular in the market. Therefore, in 2016, DML concluded that it is not reasonably certain that DML would exercise the option to extend the lease for 3 years. DML's incremental borrowing rate on 1st January 2016 was 9%. After another disappointing year of the new model, DML negotiated with BLC and the lease contract was amended on 1st January 2017 by reducing the original lease term from 7 years to 5 years with the same annual payments. DML's incremental borrowing rate on 1st January 2017 was 10% per annum.
I just scroll down for you.
Yes, please. Required. Determine the amount of right of use assets and lease liability as at 31st December 2015, 2016, and 2017, and reconcile the opening and closing balances of each year.
All right. Okay. So this is just a reassessment of lease liability, which is a very simple something that you don't have to worry yourself about. Yeah. So the company is, what is the actual lease period?
Seven years.
7 years.
Okay, but we have the option to extend it by 3 years, making it 10 years, isn't it?
Yeah.
Okay. So let's now come here. So we also incur direct cost. The direct cost can be installation cost. It's just any cost that you are going to be incurring to bring the asset to the state that it will be ready for you. So it can be installation cost, it can be delivery cost, it can be those costs that are capitalized under IS system. Those are what we call the direct cost. We put them together to have what we call direct cost. So it can also be dismantling cost. Any cost, it can also be borrowing cost. Any cost that you are going to be incurring to bring the asset to the state that it will be ready for use is a direct cost. So that will always be added to the cost of the assets. Okay. Always you should use the interest rate implicit in the list. In the list, okay. You should use the interest rate implicit in the list. But if that is not possible, you use the incremental borrowing rate of what? Of the lessee. So we don't have the interest rate implicit in the lease, but we know the borrowing rate of what? Of the lessee. Okay. The question is, how is the rental done? Is it in arrears or in advance?
In advance.
Okay. So it means that the first payment will be done today, which is 1st January. Okay. We now have remaining 6 years to what? To do under the normal one. Then we now have, if we are certain to exercise the what? The option, we now have additional 3 years. So we have new 9 months now to what? To pay, but it will be different amount that we are paying. Okay. Let's come here. On commencement of the lease, DML was reasonable certain that the option to extend the term will be what? Will be exercised. So it means that in the first year, at the time that we are taking the machine, we are certain that we are going to be what? Extending the what? The lease period by 3 years. Okay, let's come here, please. But this is what you have to do. You don't have to worry yourself much on this issue. So let's come to question number 2. Let's look at the first year, which is 2015. Okay. Let's come to first year 2015. Okay. So first year, let's have 2015. Okay. At the time of the inception, we are certain that we are going to be exercising the option. So the lease period will now be 10 years, isn't it?
Yes, 10
Okay.
years.
So let's calculate our lease liability. So we need to calculate our lease liability and also the lease liability and also the right of use. So let's calculate the lease liability. Now the lease liability, we are going to be having, we have the years here, we have the cash flow here, we have the discount factor of the incremental borrowing rates, and we have the present value. Okay, please, the option to extend will also be paid in the manner that you are paying the what? The lease rentals. So if we have the option to extend by 70 million, this will also be paid at the beginning of the 7th year. So we are going to be paying this also in what? In advance. So we have done a payment already. We have paid one already. Okay. If you want to calculate our lease liability, our total lease liability, you can bring the advance payment also. But what you have to know is that you're always going to be subtracting the advance payment. So I can do year 0 over here, then I'll have 80 million. I can bring year 0 over here, then I'll have 80 million, then I'll have 1.00 because this amount has been paid now. And the present value of the amount that we paid is the same as the 80. So there is no way we are going to be discounting this. Or, your discount factor is calculated as 1 plus R, 1 over 1 plus R exponent n. But the n over here is 0. Any number exponent 0 is 1. So that will be 1 over 1. You have a discount factor of 1. Okay. But the question is not always about we are calculating lease liability. The lease liability is the portion of the amount that we are here to pay. Okay, so we are here to pay 6 rentals for the normal lease and also 3 rentals for the option period. Is that correct? Okay.
Yes, sir.
If that is the case, from year 1 to year 6, how much are we going to be paying? 80 million, isn't it?
Yes.
Okay, you can use annuity for this one. 1 to 6. 1 to 6 will give you 80 million. So just use annuity for that. When do we use annuity? We use annuity when the cash flow, when the rental is fixed. The amount is fixed for every month. That's what we use annuity. But if the first year is 80, second year is 70, please, you can't use annuity. Annuity is used for constant cash flow. It should be the same throughout the period. So from the first 6 years that we are going to pay the rentals, it is 80. So we can use annuity for that. So the annuity is calculated as 1 minus into bracket 1 plus R exponent negative N divided by the R. And the R is the root.
4.623.
Okay, 4.623.
623.
Okay, 4.623. Okay. Can we do year 7 to year 9 over here to be 70? Can we do year 9 to year 7?
7 to 9.
Yeah,
Sir, I have a question.
yeah.
Hello, sir.
Yeah, Senior, I'm with you together.
I have a question. Please, why is it, why are we paying using 6 years for the first 80 million that was paid? Why not 7 years? That's the question.
We have paid one already. So we are not owing them that particular rentals for the first year. We are not owing them. We are looking for the present value of the amount that we are owing. So we are renting, we are leasing the asset for 7 years. But the first year renter has paid already. So we are not owing them the first year. So we'll be owing them now for 6 years.
Okay.
Okay. But if this should be paid at the end of every year, then we use 1 to 7. Because as of today, we are still owing them for the 7 years lease. Okay, but this is done in advance. So they have paid one already, remaining 6 years. Okay. The 7 to 9. Think about it, 7 to 9. Please, don't go there and be doing 1, 2, 3 up to 9. Within the 3 hours, no. Okay. After the 6 year, what will happen? We will pay the remaining 3 years. The option we will pay that one in year 7, isn't it?
Yes.
And the second year will be paid in year 8. And
Year 8.
the other
The
one
third one, year 9.
will be paid at the beginning of what? The year which is technically at the end of year 9. It will be paid at the beginning of year 10, which is technically at the end of year 9. Okay. So how do we determine the annuity factor over here? Too very simple. What you do is that do the total annuity factor for the 9 years. So do the annuity factor for the 9 years. 1 plus R exponent negative N divided by the R. So you have 1 minus into bracket 1.08 exponent negative 9 divided by 0.08. Find the annuity factor as if you are doing this for 9 years. What are you getting?
6.247.
6.247. But the first 6 years is
4.623.
Okay, so the remaining 3 years will be what? So we just subtract the first 6 years from this one.
1.64.
1.624.
Okay. So that is how you find this one. You don't have to go and do 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Maybe the invigilator will see you and you will watch your script and laugh. Sometimes you have to be, but if you know that the 1, 2, 3, 4 will work for you, fine. You can go with the 1, 2, 3, 4, 5. But please, nobody is the person who will be doing this, just only these 2 lines. The person will be giving the same max allocation like you that you are doing in 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. So what will be the present value for the first one?
370.
Okay. That will be 370. The second one is what?
114.
Okay. 114. Are we approximating, isn't it?
Yes.
Okay. So 114. Okay, sorry, 114. But the approximation should be very careful because all these figures are in million. So
It's too big.
if it is 0.2, that 2 million, if you change it to that 0.2, if you change it to million, that will be 200,000. It's a very big amount. Okay. And since we are here, let's maintain here 370 plus 114. We have
Hello, sir.
Yes, please.
Please, the 7 to 9. How many years did you calculate for the discount factor, the annuity?
No, we We just calculate the annuity for all the 9 years.
Okay.
We calculate for all the 9 years. So if you are discounting for all the 9 years, we have gotten a particular figure. Okay, but we know that the first 6 years is 4.623. So what will be the remaining 3 years? We just subtract the first 6 years from the.
Because I was calculating for the last 3 years.
On the last 3 years, then you have to do 111. You have to do 111 and add.
No, I did it like for 1 to exponent 3.
No.
I did it the annuity factor, but I did it exponent -3.
No, it means that you are doing it for the first 3 years.
Oh, okay.
Okay. But if you want to do it for the last year, you can do it 1 by 1. 1 plus 0.08 exponent 7. That will be 1. 1 over 1 plus 0.08 exponent 8. That will be another 1. 1 over 1 plus 0.08 exponent 9. Then you add it. Then you'll be getting the same figure like this. But if you do it exponent 4, that is the first 4 years. So anytime
Okay,
you have
so you
exponent,
calculated for exponent. You did it for 9 years, and you did the
exactly.
first 1 to 6. Then you left it from the 9 years figure.
Exactly.
Okay.
Exactly. Yeah. Thank you. Okay.
Yeah.
So yes, please.
In examination or in a question like this, can you request for the annuity table from them?
Yeah.
Honestly,
Is if you like you need the annuity table, they would have added to the question paper. So
in a manner, they will pay to you.
For the man accounting,
they will
you
give it
need the annuity table. You need the annuity table for man accounting because we have a question on investment appraisal. So you'll be needing an annuity table. Okay.
Is it man accounting or financial management?
Oh, financial management, you have investment appraisal. Man accounting, we have investment appraisal. So but they will not add it to the question paper. But if you ask for it, they can give it to you.
Because FM there it's attached to the question paper.
Yeah, because you are FM, you are going to be doing more of the time value of money will still be about annuity and the discounting. So they have to give you that one. Like if you should be outside exam, they can even if it should advanced taxation, they will give you the tax rate. If it should be the outside, they will give you everything. But African will want you to suffer the way they suffer. So they will not add those things to it. Okay. So at inception, initial recognition, at the time that we are taking this one, okay, please go to the exam hall. You see the further information that they are giving to you, that you only know that at the end of the year. Okay, so as of today that you are taking the asset, the only thing that you know is that we are going to be taking the asset for 7 years, and we also extend the period for 7 years. So if that is the case, what will be the entries that we are going to be passing? This will be the lease liability that we are going to be having. What will be the right of use? We need to find the right of use. Okay, we are owing the people 484 for an asset that they are giving to us. All things being equal, if we don't have anything to do again, we can say that, okay, the asset that you are giving to us, this is the value that you are selling the asset to us, which is the 484. Okay, but what is happening is that aside this 484, we have already paid 80 for this. I've given you an item, you have paid 80, but you are still owing me 484. It means that the amount of the item that I've given to you is the amount that you are owing me, and plus the amount that you are giving to me. Okay, so the right of use, you have your lease liability, which represents, so you have your lease liability, which represents the present value of the amount that you are here to pay. Then you bring your advance payments. Okay, advance payment over here. Then this is the amount that we are supposed to pay for the assets. We have already paid 80, but we are still owing the people 484. So what is the total value of the thing that they are giving to us? Is the amount that we have paid and the amount that we are here to pay. Okay, then we now bring the issue of, we now bring in the issue of the, okay, we now bring the issue of the direct cost. We now bring the issue of direct cost. Direct cost can be delivery cost, can be any other cost that will be added to the initial cost of the asset. And that is how much?
That's 15 million.
15 million.
So that will be 15 million. So what will be the right of use?
$579.
Okay, 579. Okay. So this is the time that we are leasing the asset, initial recognition. At the end of the year, what will happen? We are going to be using the asset for 1 year. We need to depreciate the asset. So we depreciate this particular asset for how many years?
For 10 years.
Okay, that will be 10 years. Okay, we are going to be using the asset for 10 years. The first 7 years plus the 3 years. So that will always be the 10 years. So if you have the option period, yes, please.
But I see in the question, they brought the useful life of the machine is 12. So
We cannot use it for 12. We are using it for 10 years. So the remaining 2 years will be used by the owner of the. Okay. The remaining will be used. So we are going to be using the asset for only 10 years. The remaining 2 years, they are going to be the one using it. So this will be every year is what?
57.9.
7.9.
Okay, so we have 57.9. What will happen to the lease liability? We have to now amortize it, isn't it?
Yeah.
So we have to be amortizing it by adding the finance component at the start of the year. So at the start, our lease liability was 484. Okay, this is the amount that we are here to pay. Then we have the finance cost. Okay, the finance cost will be 0.08 multiplied by 484. What are we having?
38.72.
Okay, 38.72. Okay, so can we make it 339?
39.
Okay. Okay. Are we going to be paying any amount at the end of the year? No, we have already paid at the beginning of the year. Okay. So your lease liability at the end of the year will be how much?
$523.
Okay. So this is the first one. Okay. At the end of the year, what are they saying? At the end of the first year, what are they saying?
Modification.
Okay. So something has happened. However, after the first year of production of the new model, DM assessed that the model is not popular in the market. Therefore, in 2016, they'll conclude that it is not reasonable certain that the D will exercise the option to extend the lease for the 3 years. Their incremental borrowing rate on 1st January 2016 was 9% per annum. So they say after first year, okay, technically the first year will be from 1st January to what? 1st January 2015 to 1st January 2016, isn't it?
Yes.
Okay. So since they are asking you to do this, for every year, what will happen is that the reassessment will be done at 1st January 2016. But if they are only asking you to show for 2015, what will happen is that you know that 31 December is the same as what 1st January, isn't it?
Yes.
So you do the reassessment at the end of this year. Okay. But since they are asking us to do this one, let's respect the 1 year so that we do the reassessment in the following year. Okay. So the reassessment will be done in the following year, which will be January. So in the first year, our lease liability will be 523, and our right of use, the carrying value of our right of use will be calculated as 579 minus 57.9, because we have done 1 year out of that. What are we having?
$521.1.
Okay. So this is our
521.1.
Okay, this is the first year. Okay. But please, if they are asking you to do this for only 1 year, please bring the reassessment to the end of this year. Because 1st January and 31 December, technically they are the same. Okay, whenever you are saying that, okay, if you are doing cash flow and they say that, okay, the money will be, they are going to be paying at the beginning of the following year, we bring it to what? The end of the current year. So the end and the beginning are the same. Okay, but since they are asking you to show it for every year, so you just respect the 1 year. So 1st January to 1st January 2016, that is a 1 year. So the reassessment will be done on January 2016 for this year. So we have January 2016. We now have to reassess our liability. So let's come to reassessment. As at this date, what is the new amount that we are going to be paying? Okay, they are saying that they are not certain to what? They are not certain that okay, they have concluded that it is not reasonable certain that the DM will exercise the option to extend the lease for 3 years. So it means that we have to remove the option from this particular amount. It means that we are left with what? How many years? How many years are we left with if we are not extending?
6 years.
Okay. But the 6th year we have paid 1 year already, isn't it? We are going to pay 1 year at the
That is
beginning.
what has brought it to 6 years.
No, at the beginning of 2016, we are still going to be paying
Pay another, okay, yes.
Okay.
Another
Yes,
installment.
so left with 5. Liability.
Okay, we are left with liability of 5, isn't it?
Yes.
Would the rental payment change?
No, it will still be the 18 million.
Okay, so what we have to do is that at the beginning of this year, our lease liability brought forward. Let's bring our liability brought forward before we move on. So at the beginning of this year, lease liability that will be brought forward will be 523 minus 80. Do you agree?
Yeah.
Okay, and that will give us how much?
443.
443.
Okay, it means that we have paid the 80 at the beginning of this year. We are paying in advance, so we are owing the people 523. At the beginning of this year, we paid the 80, so we have a balance of 443. Our right of use will be the carrying value of the asset, which will be 521.1. If we should continue, we should still continue. It means that we amortize this, but we are not continuing. And option of 3 years has been included over here. So we now ask ourselves, if the option was not there, what should have been the amount that we should be owing the people as at today? That's what we are coming to do. So we now look at the reassessment of the lease liability. Reassessment of the lease liability. Okay, and we have the years now. Please, over here, you can ignore the years. Okay, you know that your lease liability will be calculated as 80 multiplied by annuity factor for 5 years. Is that correct?
Yes.
Okay, so just find the annuity factor. Let's multiply and get the answer.
$3.993.
Okay, so we have 3.993. So if you multiply, what are we having?
Please, are we going to use the new incremental rate or the old one?
Sorry. We every date at the time of every date, the incremental rate will be 9%. So if you're not giving 3 each rate,
then it's 388. Okay, 389.
Okay.
3.889.
Okay, you always use
So
the new.
3.89.
Okay, 3.890.
Yes.
Okay, so the arrangement will now be made taking into consideration our borrowing rate. Okay, so at each date you use the borrowing rate or the interest rate implicit there. It means that the arrangement will be made now taking into consideration that one. Okay, not the borrowing rate at that time is not that. Since you are now going to modify this, it means that you have to now pay me the amount based on the interest rate. What are we having if you multiply?
311.2.
Okay, so we have 311. Okay, 311.2. But what is our lease liability at the start?
443.
Okay, but the supposed lease liability at the beginning of this year should be what?
Be the 523.
523.
No, this is for last year. Oh. Okay, and we have paid 80 this year. We have paid 80 at the beginning of the year already. So this will reduce by 443, isn't it?
Yeah.
Okay, or if you like, you can add the 80 thinking that you haven't paid the 80 yet. So that will be 391.2. Then you subtract it from this one. The difference will still be the same as you looking for the lease liability. We are paying the renters in advance at the beginning of every year. So at the beginning of the current year, we have already paid the 80 from the 523. So we are having 443. Okay, but our supposed lease liability for the remaining 5 years supposed to be 311.2. But what are we having in the books? 443. What is the difference?
$131.
Okay, so lease liability will now be, we now reduce the lease liability at January 2016. So we now have the balance brought down. Okay, the balance brought down will be 523 minus the 80 that we have paid, and that will give us 443. So there will be a reduction, decrease in the lease liability as a result of reassessment. So that will give us, the reduction is what? Then we come to the new liability.
131.8.
Okay, 131.8. Then we now have 311.2. Okay, so this 131.8, the entry,
Sir,
yeah. I'm with you.
yes, please. I'm sorry to take you back on the reassessment.
Yeah.
I didn't understand why you were using the 5 years.
No, we are leasing the asset for 7 years, isn't it?
Yes, please.
Okay. We are paying the renters at the beginning of every year. Okay. So at the time that we lease the asset, we have paid, which is 1st January 2015. We have paid. So at the beginning of January 2015, we are owing six years now because we have paid 1 year already. Okay. At the beginning of 2016, what will happen? We still pay the renter for that particular year. Okay, so we are going to pay additional renters. We have paid 2 renters now. We are going to be owing them 5 years. So we are looking for the amount that we are owing them. Okay. Are you okay?
Answer 20. Yes, sir.
Okay, thank you. All right. Please, the entry that you are going to be passing for this is what? The liability is reducing. Okay. You have to go and reduce the asset by the same amount. So the decrease in the lease or the increase in the lease liability will be adjusted against the lease liability and then the right of use. They are all estimates. So it means that the amount that we have added to the right of use was higher than the supposed amount. So you also go to your right of use. You go to your right of use, then you also reduce that. So you have the carrying value of the right of use, which will be 521.1. Then you bring the what? The reassessment of lease liability. So you bring that one, the amount will be adjusted against this. So we have 131.8. What will be the carrying value now?
389.3.
Okay, so 389.3. So what do we do? Subsequent measurements at the end of this year, we amortize the lease and we depreciate the right of use. Okay, so what we do is that we have the lease liability, we now amortize it. Okay, we now amortize the lease liability by having balance as start. The balance as start will be the new amount that we have calculated. That will be 311.2. Then we have our finance cost. Finance cost of 0.09 multiplied by 311.2. What are we having?
28.
Okay. So the total will give us 339.2. Is that correct? Okay. We are going to be paying at the beginning of next year. What will happen to the right of use? It will be depreciated. So we have the right of use, depreciation of the right of use. So we have depreciation of the right of use, which will be 389.3 divided by how many years?
Not 5 years.
No. Divided by how many years?
6.
6 years.
Oh, 6.
6. Thank you. We have used the asset for only 1 year.
Okay.
Okay. But the lease period is, we are paying the lease period at the beginning of the year. But the asset will be used at the beginning of the year to the end of the year. So we have used the asset for only 1
Okay.
year.
Okay. Okay. Okay.
So that will be 389.3 divided by 6. I'm having 64.8. Okay. 64.8. Let's come to 2016. Okay, 2016. What will be our lease liability? Our lease liability will be 2016. At the beginning of 2016, our lease liability will be 339.2 minus 80. Is that correct?
Is it 2017 or 2016?
Okay, that will be 17.
Yes.
Okay, that will be 2017. Okay. At the end of 2016, we are not going to be paying because the next rentals will be paid at the beginning of 2017.
Yeah.
So this will give us how much?
$259.2.
Okay, 259.2. Okay, what will be our right of use? Our right of use will be 389.3 minus the depreciation for the last year. I'm having 324.5. Let's now go to what they are saying again about this. They say after another disappointing year of the new model, DMA negotiated with the BLC and that the lease contract was amended on 1st January 2017 by reducing the original lease term from 7 years to 5 years with the same annual payment. The DML's incremental borrowing rate on 1st January 2017 was what? 10% per annum. Okay, if they are now reducing from 7 years to 5 years, what will be the remaining period on the lease as at 1st January 2017? As at January 2017,
Not 3 years.
we have 5 years remaining, isn't it? As at this
Yeah.
date, we have 5 years remaining. Now they are moving from, if we are still using the 7 years, we'll be having 5 years remaining because we have done 2015 and 2016. So 2 years is gone. We have 5 years. But they are now removing from 7 years to 5 years. So it means that the original lease period should be 5 years and we have done 2 years. So at this date, we are left with what? 3 years. Okay, we are left with 3 years, and we have already paid this year's renter at the beginning of the year. So we'll be owing the people for how many years?
Three
2 years.
Yeah,
3 years.
no. If it is 5 years, if the lease period was 5 years from 2015, okay, we are in 2017. We have done 2 years already, isn't it?
Mm.
Okay. At the beginning of 2017, we have a remaining of 3 years,
Yes.
isn't it? Okay. And at the beginning of the 2017, we are going to be paying them because we are paying in advance. So we have paid 2017 amount already. It means that we are going to be owing them for 2018 and 2019. So we are owing them for only 2 years. So we find a lease liability for only 2 years. Okay, because we have already paid what? We have already paid the 2017 renters. So we come to the reassessment. So the reassessment, we won't do much again. Let's come to 80 multiplied by what will be the annuity factor for 2 years using 10%. We have 10% now. What will be annuity? 2 years. Using 10%.
1.736.
Okay, 1.736. So how much are we going to be having?
One 138.88.
138.88.
Okay, so as at the beginning of this year, this is the amount that we're supposed to be owing the people. This is the lease liability. But how much are we having there? So we now reduce this amounts. Okay, 259.2. I'm having 120.32. Is that correct?
Yeah, 120 point.
Okay, 120.32. So what will happen? Our right of use will also decrease by that amount, isn't it? The carrying value will be 389.3 minus 64.8. So our right of use is what? 389.3 minus 64.8. Okay, so I'm having 324.5. So the decrease in the lease liability will also be reduced by this. So decrease in lease liability will also be reduced by this. So we have 120.38. Okay, please, any increase or decrease in the as a result of the reassessment will be adjusted against the lease liability and also the right of use. Okay, so what will be the right of use at the beginning of this year? What's supposed to be the right of use? We have 204.18. Okay, so at the end of December 2017, these are the entries that you will be doing. So you have the depreciation of the right of use. The depreciation will now be 204.18. What will be the remaining useful life? It will be divided by what?
Five. 4 years.
No.
5 years.
No.
3 years.
It will be divided by 3 years. We are left with only 3 years of the lease period. The lease period has been reduced to 5 years. If you should stick to the 7 years, it will be 5 years. But we have reduced this to 5 years instead of the 7 years. So the asset will be used for additional 3 years. What will be the depreciation? That will be 68.06. And our lease liability at the end of this year will be amortized. So we have lease liability, we have at start, and that will be 138.88. Then we have the finance cost. Finance cost will be 0.1 multiplied by the balance at start, and that will give us, so we have the 138.88. So we have 1.1 multiplied by 138.88. I'm having 13.89. So at least liability at the end of this year, 0.89, we add the 2, 138.88. I'm having 152.77. So you can find the carrying value or your right of use at this date. The right of use will be equal to 204.18 minus 68.06. Then you have our carrying value there. 204.18 minus 68.06. We have 136.12. Okay, this is all about this. This is all about what they're asking you to do. Okay, is about the reassessments. Okay, but they cannot, because of the time and then the max allocation. If they want to do this, maybe it can give you like maybe 15 marks or something. So what they will do is that maybe they can ask you to do it for maybe 2 years. Okay, they can ask you to do it for 2 years, but they're asking you to do it for only 1 year. What you do is that the 2017 reassessment should be brought to 2016, because at the beginning of 2017 is the same as the end of 2016, or the beginning of 2016 is the same as the end of 2015. So if they're asking you for only 2015, the reassessment for this particular one will be done at 2015, and these figures will be adjusted against those figures. So what we do is that if it should be 2015 that we are doing this, we are going to be reducing our lease liability by the 131.8, and we are also going to be reducing our right of use by that one. So it means at the end of this year, at the end of 2015, we'll be having this figure, and we'll be having a right of use of this figure. So we just bring it to the 2015 year at the opening balances without doing the adjustment again. So if you do it like that, there's no problem with that one also. You have to do it at the end of the year, then you bring it at the as a closing balances. Then 2016 too, you do the reassessment for 2017 in 2016, because it will be done at the beginning of the year. So you don't have to go and subtract these figures from 2017 again. You do all this adjustment at the end of 2016. Then you just bring the figures as the opening balances for the next year. Okay. But since they are asking us to do it year by year, that's why we are showing this at the beginning of every year, at the beginning of every year. If it should be only 1 year, the reassessment at the beginning of 2016 will be done at the end of 2015. So that in 2016, you just bring the balances like that. All right.
Senior,
Yes.
please, so the annuity for 2017, no?
Yeah.
The annuity for 2017 for the reassessment now.
Yeah.
My line drop. How many years did we use?
We used 2 years.
2 years, okay.
Yeah, because we have 3 years remaining. We have reduced our lease period to 5 years. We are already used 2 years. So we have 3 years. Okay. But for these 3 years, we are going to be paying for 1 year at the beginning of the year. So we are going to be owing the people 2 years from now. So we only look for the lease liability. Okay, so that's why we use the 2 years. Okay.
Okay.
All right.
Okay. Thanks.
All right, Sina. Okay, please don't be scared. Okay, these are your corporate reporting questions. Gone are the days that they will ask you a question on investment property. That is not the case now. They want to meet what international standards. Okay, you cannot be a chartered accountant in Ghana under ICAG. You go to UK, you cannot do small adjustment for entities there. So they want to meet the international standard. If you want to go to Pakistan, they are the people doing the standards. They are the actual people doing the standards. Because there are questions. If you look at Pakistan questions, you feel like you haven't learned anything. It's normal. They are the actual people doing the work. And IC is now picking questions from that side. November that they brought 2 questions from the Pakistan people, and that was reassessment and reassessment of lease liability and also reassessment of provision. Question number 3.
Question 3.
Yeah.
On 1st January 2020, Uranium Limited completed installation of a manufacturing plant which will be required to be dismantled at the end of its 8 years useful life. UL paid $3,000 million for the plant. On 1st January 2020, it was estimated that the cost of dismantling applicable discount rate at the time of initial estimates of dismantling costs was 10% per annum. Estimates of dismantling costs and applicable discount rates were reviewed as at 31st December 2020, $75 million and 15% per annum.
Is it my network or is our own?
Annum respectively.
Okay.
The first at 31st December 2022 was assessed at $1,900 million. UL has a policy to subsequently measure plants using the revaluation model and provide depreciation on straight line basis. Required. Prepare relevant extracts from UL's statement of profit or loss and other comprehensive income for the year ended 31st December 2022 and statement of financial position on that date. Show comparative figures.
Okay. So this is about IAS 37, but it is on the advanced side of the IAS 37, which maybe the time that I was doing IC, I haven't heard about reassessment of dismantling costs. I haven't heard about that one before. But Pakistan people are the ones doing it. See, most of my questions are from Pakistan. Okay, they are from Pakistan. So, yes. So even if not for them, maybe I won't know certain things. Okay, I won't know. Maybe we all be here and be deceiving ourselves, and students will go and fail. Okay, so this is about reassessment of dismantling costs. Okay, at the date, which is January 2020, the company completed an installation of manufacturing plants, which would be required to dismantle at the end of 8 years useful life. The company paid $3,000 million for the plants. On 1st January 2020, it was estimated that the cost of the dismantling will amount to $5 million, an applicable discount rate at the time of the initial.
A lot of people who qualified 5 years ago, 10 years ago, yes.
Do anything.
Hello. Hello.
Yes, ma'am. It is so. Yeah, someone is talking.
Even some of the teachers, in some of the facilities, they can't solve this question. Those people teaching at some.
They don't know anything.
Oh no.
I say, well, it is well. So You see, sometimes we look at a question, you see, like I should have written the ICA some time ago because it was very cheap. That time it was very cheap, very cheap, very cheap. But how we go do them? We just have to manage and move on. Okay. So what do we have to do at the time that we are?
As there with some of us, the FR warriors.
Okay. So we need to report, well, we need to record this transaction on the date of the completion. So how do we recognize this? So we have to recognize this on 1st January 2020. Okay. So we have to recognize the asset in our book before we talk about other issues. So if you purchase an asset on 1st January 2020, how much are you paying for the asset? What will be the transaction that you are going to be, or how will you record this? So we have to record this on 1st January 2020 before we think about any other after issues. So at the date of the transaction, we need to recognize this transaction. So this will be question number 2. So that will be January 2020. Then we have the, okay. So we have the cost of,
question number.
okay, sorry.
Question 3. Question 3.
Okay, question 3. So we have the cost of the assets at that date. So we need to record the cost of the assets. Okay. The cost of the asset will be the amount that we are what? The purchase price, which was, I'm sure that was 300 million.
3,000.
3,000. Okay. How do we treat the dismantling cost? We present value and add it to this one. So we have the dismantling cost over here. So dismantling cost, we present value. So what is the amount? It's 500, isn't it? Okay. This 500 will be paid in 8 years' time. So what is the today's value of the 500? So we present value this by having 1 over 1.1 exponent 8 multiplied by the 500. Okay. So we have 1 over 1.1 exponent 8. How much are we having? Okay. How much are we having? The discount factor for 10%, 8 years.
Hello, sir.
Yes, please.
Please, what rate are you using?
It's 10%. They have given us a rate there to be 10%. Or the applicable rate at the time of the initial estimate of dismantling cost was 10% per annum.
Yes.
Yeah.
But I'm seeing 18. That is why I'm asking.
Oh, really?
Yes, you wrote one.
No, it's 1.1 exponent 8.
Is the exponent
That's
8,
8
the
years.
years. Is the exponent 8. This will be paid in 8 years' time. So that will be exponent 8. Okay, let me write it very well for you. Sorry. So 1.1 exponent 8. How this one is clear now?
Yes, sir.
Okay. Okay. Or let me just put brackets here. Okay. Let me write it. Please forgive me. Let me do it very well for you. Okay. 1.1 exponent 8 multiplied by 500. Aunt Emilia, I hope it's clear now.
Yes, please.
Okay. So what is it?
233.25. 33.25.
3.25.
Okay. So what will be the value of the assets?
3,233.25.
Okay. So we have 3,233.25. So what we are going to be doing is that we also have provision for the dismantling cost.
3 point.
Okay. So we are going to be having provision for dismantling cost of 233.25. Okay. At the end of the year, what will happen? 31 December, how do we subsequently account for this 2020? The asset will be depreciated, isn't it? And the dismantling cost will be increased. We unwind it. So let's come to the depreciation of the assets. So the depreciation will be 3233.25 divided by how many years?
8.
8 years. Okay, how much are we getting?
104.13.
Okay, so we have 404.13. So we have to unwind the discounts. Okay, so we come to finance cost on the discounts. Okay, finance cost on the discounts. So we have finance cost on the discounts. That will be 0.1 multiplied by the present value. This one is just like compounding. Every year we increase it so that we can have the 500 million at the end of the 8 years. So you compound this at the end of every year, 2.5. What are we having?
23.325.
Okay, so 23.325. Can we make it 33?
33.
Okay, so what will be our provision at the end of the year? Our provision will be the balance at start, which is 233.25 plus the finance cost component. So we add it, we'll be increasing it till we get the 500 at the end of that year. So that will be 23.33. What will be the total?
256.58.
Okay, 256.58.
Yes.
When are we doing the reassessments? Estimate of dismantling cost and applicable discount rate were reviewed as at 31 December. So it means that will be the end of what? The current year. We are now in 2020. So let's count to 2021. 2021, our carrying value of the assets will be 3233.25 minus the what? The depreciation of how much? 404.13. What will be the carrying value at the beginning of this year? That will be 404.13. So January 2020. What is the value?
$2829.09.
Okay. It is 09. I'm getting 12.
$2829.12.
Okay.
0.12, yeah.
Okay. The provision, the carrying value of the provision at the beginning of this year will be 256.58, isn't it? Okay. Let's count to December. The revision is done at December, so we have to count to December 2021. At December 2021, we are going to be depreciating the assets for additional 1 year, which will be 3233.25 divided by 8. The depreciation will still be the same as the 40.13. Okay. Then our provision will now be increasing. So the provision we now have at start of this year plus the finance cost. So at start of this year, which is 256.58 plus the finance cost, which will still be on the 10%. Okay, because we still apply the 10% on this figure before the revision. So 2.6. Okay. How much are we having?
25.66.
Okay, so we have 25.66, and this will give us
282.24.
okay, 282.24. Okay, can we find our asset value, the carrying value of the asset as at the end of this year, 2020? So can we find the carrying value of the plants. Okay, that will be, we can say that is 2829.12 minus 404.13. Do we agree to that?
Yeah.
Okay. So how much are we getting? 2829 points.
24.99.
We get 2,000.
Okay. 24.99.
24.99.
Okay. They are talking about re-estimation now, isn't it? This is why we pay attention to. So we do this till 2021, December 2021, before we come now. They are saying that the estimate of dismantle cost and applicable discount rate were reviewed as at 31 December and we are revised to 475 million and 15% per annum respectively. Okay. At 31 December, how many years do we have left for the assets?
6 years.
Okay, we have 6 years. Okay, so it means that this 475 will be spent in 6 years' time, isn't it? This 475 now, which is given to us now on 31 December 2021, this will be spent in 6 years' time, isn't it? Okay,
Yes.
if that will be spent in 6 years' time, okay, what will be the present value of this amount now? So we find the present value of this now using the 15% because they have changed the amount together with the what? With the 15%. Please, this is a change in an estimate. Don't go back and say that, okay, you assume that 475 will be the value at the beginning of the year. If you do that, you will still be getting the same value that the person will be doing by discounting this for 6 years. The person will still be getting the same thing. You are spending the 475 6 years from now. So what should be the today's value of this at 15% discount rate? So we now discount this to know the new present value of the property.
05.
Okay, so let's do that. So let's do our closing balance, our reassessed provision, or the actual provision at this date. So what we have done was based on 500, and we have this figure in our books. Now they are saying that this should be only 475. So we have 475 multiplied by 1 over 1.15 exponent was 6, isn't it?
Yes.
Okay, how much are we getting?
Yes.
205.35.
205.36.
36. Okay.
Yeah, 36.
This is supposed to be the present value of our provision. But how much are we having on the provision account?
82.24.
So let's have the decrease. There's a decrease in the provision, isn't it?
Yes.
Okay. If provision is decreasing, what is happening? Is it an income to the entity?
Yes.
Okay.
Indeed.
How much is the decrease?
76.88.
Okay. The treatment of the decrease depends on the what? On the measurements basis that the entity is using. So let's come and determine here. Okay. What are they using? UL has a policy to subsequently measure plants using the revaluation model and provide depreciation on what? Straight line basis. So if you are using a revaluation model, any decrease or increase in the lease liability or in the provision is treated as what? A fair value gain or a fair value loss. Okay. So since we are using revaluation, it means that any treatment in or any difference in the provision will be treated as, okay, we have revalued the provision and we have gotten this figure. So the provision was revalued on this date. We have gotten 205.36. That is a difference of what?
76.88.
76 point what?
88.
Okay. So if liability is reducing, yeah. Since the network is bad.
I lost with the 24.99.
The 24.99. Okay, it's just the value of the asset. The value of the asset was at the start of the year was 3233. We have used the asset for 2 years, and the depreciation every year is 404.13. So if you want to find the carrying value of the asset, it will just be the cost minus the accumulated depreciation of 404.13 multiplied by 2. We have used the asset for 2 years. So the cost minus the accumulated depreciation for 2 years. That was how we got the 24.99. Okay. All right. I hope you are sorted now. Please take look at this one again. If the entity is carrying the asset using a revaluation model, any decrease or increase in the provision will be treated as a revaluation gain or revaluation loss. Okay. But if they are carrying the asset at cost model, it means that the provision that we have added to the asset was higher than actual provision. So this 76.88 will be subtracted from the provision the same way it will be subtracted from the asset, the value of the asset, or the carrying value of the asset. So if they should be using cost model, we come here and subtract the 76.88. It means that we have added a provision of 76.88 in excess to the value of the asset. We go and subtract. But if there is increase in the provision too, we increase the provision and increase the asset if we are using cost model. Okay. But if we are using revaluation model, the reassessment of the provision will be seen as a revaluation of the provision. So any difference over there will be taken to a revaluation account. So the liability is reducing. This is a gain. So that will be a revaluation gain for this year. The entity has to recognize a revaluation gain of 76.88 to this particular year. And the provision will now be carried at a new amount of 205.36. Let's come to the other part. Okay. The fair value of the plant, including the dismantling cost, as at 31 December 2022, was assessed at 1900 million. So it means that the asset has been revalued. The asset has been revalued on 30th June. The asset has been revalued on 31 December 2022. So let's count to 31 December 2022. Okay, December 2022. We need to find the carrying value of the asset. Then we compare with the what? With the revalued amount. The carrying value of the asset will be 2424.99 minus the what? The annual depreciation, because the depreciation will still be minus 404.13. Is that correct?
Yes.
Okay.
Correct.
Yes.
So what are we having?
2020.86.
2020 point what?
86.
Okay. But what is the revalued amount?
Is it 1,900?
Yeah, the revalued amount will be 1,900. What is happening over here? We are having a revaluation surplus, isn't it? We are having a revaluation loss rather, not surplus.
Yes.
Okay. So that will give us 2020.86 minus 1,900. What are we going to be having?
120.86.
120.86, isn't it? But
Yes.
there was a previous revaluation gain, which is taken to other comprehensive income of 76.88. So this revaluation loss will now be shared like this. The other comprehensive income will take the portion that we are sending there. It's just like you went to the market, you sold and you made a profit of 200 cedis. The next day that you went and make a loss of 250, it means that you haven't made a profit at all. You have made a total loss of what? 50 Ghana cedis. You made a profit of 200. You went the next day, you are making a loss of 250. So it means that you have made a net loss of 50. So the 76.8 should be cancelled. So we go to OCI and take the 76.6. Then the remaining loss will be taken to profit or loss. How much are we getting?
3.98. 43.98.
43.98. Okay. Let's come to the finance cost on the provision at the end of the year. So finance cost for the provision will be 0.15 multiplied by 0.15 multiplied by the new provision, which is 205.36. How much are we getting?
$30.80.
Okay, 30.80. So our total provision now will be the balance at the start. So we have the balance of 205.36. Then we have the finance cost for the year of 30.80. What will be the total?
236.16.
Okay. So we have 236.16. Let's now come to the requirement of the question. Okay. So prepare relevant extract from statement of profit or loss and statement of other comprehensive income for the year ended 31 December and statement of financial position as at that date. So let's do statement of profit or loss. They say we should show comparative figures. So we have statement of profit or loss. We have the extracts. So the comparative figures means that we show the current year with what? The previous year figures. So we have the 2022 here. You have 2021 here. Then you have 2020 here. Okay, so the first item that will come will be depreciation, isn't it? Depreciation for the current year will still be the same figure, so 404.13. Depreciation will also be 404.13. 404.13. Okay, what will be the finance cost? So let's calculate the finance cost for each of the year. This year is 30.80. Let's go to last year. Finance cost or 25.66. And we have the last, that will be 2020 was 23.33. Okay, we are going to be having a revaluation loss for this year. Revaluation loss for this year, which will be the portion that is coming to profit or loss. That will be 43.98. There was no revaluation loss. This will be a revaluation gain. Let's go to the other comprehensive income. That is where we are going to be showing the revaluation gain or loss. So other comprehensive income. Okay, so you show the current year, 2022, 2021, and 2022. Okay, you show a gain or loss. Okay, this year it was a loss of 76.88. 2021 was a gain of 76.88. This will be dashed. Statement of financial position. You show the assets, which will be 2022, 2021, 2020. So we just show only the current value. The plans at the end of the year, the new amount will be the 1,900, which is the revalued amount. Okay, 2021, it was 24.99, and 2020, it was the current value of the assets. 2020 was 2829.12. 2829.12. Then you count your liability, which will be the provision. So we have the provision, the current year provision, which is a total, is 236. 236.16. 2021, what was the provision? We have to go and look for it. That will be 205, which is a revised amount. So 205.36. And 2020, 2020, the provision, at the end of 2020, the provision will be 256. 256.58. Okay. So this is how they are asking you to show as a comparative figures. So you show the present year, then you add the what? The previous year's figure. You show the previous year's figure also. That is the comparative that they are talking about. Any issue before we move on to question number 4? All right.
So
Question. Yes, ma'am.
depreciation will not reflect on the statement of financial position.
Now we have taken the depreciation from the, so we only show the carrying value. We don't do cost minus accumulated depreciation. We don't do that. For professional level, we don't show that. We only bring the carrying value by doing the workings. So we have done that now. Okay. So the depreciation will show for only statement of profit or loss. So the figure that you'll be bringing to statement of financial position should be the net of the depreciation. All right. So it's not the cost less accumulated depreciation, then you show the net book value. No, we only show the net book value at this level. Okay, the first year we don't find present value, we just increase the figure. Or if you want to find the present value for the first year, what will be the present value? If you want to find the present value for the first year, what you also do is provision at the beginning of the year. The provision is 1 over 1.1 exponent 8. Okay, then multiply by 500, you are supposed to get 233.25. So at the end of the year, if you want to find this 256 at the end of the year, you can also find this like this. Okay, you know that you have 500 to spend, okay, at the end of 8 years. By the end of the first year, 2020, it means that you have used 1 year. You have a remaining 7 years. So what is the present value of the 500 in 7 years time? So you can also do 500 multiplied by 1 over 1.1 exponent 7. You'll be getting something closer to this. Okay, so you can also try that. So I don't know which one you are talking about, but the first year dismantling cost, which is a provision, we look at the start figure, then we increase it by the finance cost. So you can also avoid the finance cost by just calculating, okay, I've done 1 year already. I'm going to be spending 500 million in the next 7 years. So what will be the present value using 10%? You will still be getting the 256.58. So you can just find a difference between the one that you are getting there and you get your finance cost without calculating the finance cost yourself. That is also another way of doing that also. You just have to be creative in the exam hall so that you don't have to waste your time. You don't have to waste your time. Okay. Question number 4. Auntie Agnes, are you there?
Yes, please.
Yeah.
Question 4. A division of Ziwa Limited has the following non-current assets, which are stated at their carrying values as at 31st December 2022. We have goodwill, property, plant and equipment, land and building, plant and machinery. Since the assets are used to produce a specific product, it is possible to identify the cash flows arising from their use. The management of Ziwa Limited believes that the value of these assets, the value of these assets may have become impaired because a major competitor has developed a superior version of the same product. Forecast cash inflows arising from the use of the assets are as follows. The following additional information is useful. 1. the directors are of the opinion that the markets would expect a pre-tax return of 12% on an investment in an entity that manufactures a product of this type. 2, the land and building are carried as revaluation. The surplus that remain in the revaluation surplus reserve as at 31st December 2022 is 65 million Ghana cedis. All other non-current assets are carried at historical does not have a market value. Be sold at 270 million Ghana cedis, and the plant and machinery could be sold for 50 million Ghana cedis, net of direct selling cost. Required: A. Calculate impairment loss to be recognized in the account of Dewa Limited. B. Explain how the loss for the year December 20.
There was a time that we have been watching cassettes and there will be scratches. But I think right now we don't have cassettes in the system again. So, Auntie Agnes, why are you suffering from the scratches?
Oh, sorry. I think it's my network.
Okay, you don't have control over it. It's Ghana. If you are living in Ghana, you have a lot of problems. So,
It feels like today the network is not good at all.
At your end, because today me, I'm enjoying
But
stable
I've been
network.
going off and on like that.
Is it MTN?
MTN, even the Vodafone is not coming at all.
At your place?
Yes.
Oh, it should 10:30, then you can mess up. For now, then you should not be messing up because I'm using Vodafone and my own is stable now. Okay. I don't know what is, maybe the cable issue. Are they still on that cable issue? Okay. So please, this is what I'm saying, that they can give you a normal impairment question, and this is one of the normal impairment question for corporate reporting. Okay. They are saying that there is an issue of impairment. When do we have impairment? Impairment is always determined when you realize that, okay, the benefit that you are going to be getting from the assets will be lower than the expected benefit that you are estimating to be realizing from the assets. What am I trying to say? What I'm trying to say is that you have purchased an asset at 50,000. Okay, this asset will be used for 10 years. Okay, so the estimate is that you'll be using the asset to produce 1,000 units, or the maximum capacity of the asset will be 1,000 units for the 10 years. Okay, government has now passed a legislation that is going to be limiting the asset to only 800 units. So instead of you having 10,000 units from the asset for 10 years, you'll now be having 8,000. Okay, the 50,000 was expected to give you 10,000 units. Now you are going to be getting 8,000 units. It means that you can't use the same 50,000 to produce the 8,000 units. So what portion of the 50,000 is giving you the 8,000? That is what we call the recoverable amount, and the difference over there is the impairments, because the asset will be underproducing by 200 units, and that 200 units we are not going to be getting it, but that 200 units has been estimated in the value of the asset. So let's find that one and remove it. That is the impairment that we are talking about. But let's come here. How do we calculate the impairment loss? At that date, at the date of the impairment test, this is what we have to do. So at the date that you are carrying out the impairment test, please look for what is the carrying value of the assets. So what is the carrying value of the assets at the date of the impairment? Okay, the question is, how much can we recover from the assets? The recover can be, if we want to sell the asset today, what is the net amount that we are going to be selling it? Or if you want to continue using the asset, what is the present value of the benefit that we are going to be getting? That will be the value in use. So the higher of any of the two is what we call the recoverable amounts. So recoverable amount will be the amount that you are going to be recovering from the assets. As at today, if you want to sell it right now, what is the net amount? which we call the net realizable value. You are going to be selling the asset for 2,000, but you have to pay someone agent 100 before. It means that you are going to be getting 1,900 from that. That is the net realizable value. Then, if I want to continue using the asset, what is the benefit that I'll be getting from it, and what is the present value of those benefits? We look at it. The higher of any of them, we pick it. Then we compare the carrying value with the recoverable amount. As soon as the value of the asset in your books is higher than the benefit that you should be getting, it means that the asset has impaired. You are carrying the asset at a value more than the benefit that the asset can offer you. So the difference over there will be the impairment loss. Okay. Based on this particular question, we have been given carrying value of the assets at the date of the impairment. So that is December 2022. We are given the asset December 2022. Those were the carrying values. Please, can we determine the carrying value once again for ourselves? Goodwill is how much?
70.
Okay, 70. Okay, land and building is what?
320.
Okay, land and building.
320.
320. And the next one is what?
Plant and machinery.
Okay, plant and machinery is what?
Plant and machinery.
Okay, how much is it?
110.
110. The total amount to give us what?
500.
500. So these are the carrying amount. We have to determine the recoverable amount. Please, for corporate reporting, nobody's going to give you a recoverable amount. If they are giving the recoverable amount, then it might be they are going to be asking you for different things. You have to determine the recoverable amount yourself. The recoverable amount is the higher of the net realizable value or the value in use. And we can actually calculate the value in use. The value in use is the present value of the future cash flows that you are going to be getting from the continual use of the asset. And the question has given us future cash flows. Okay, so we have the forecast cash flows. It should always be the future cash flow. The future cash flow should be starting from a year from the time that you are doing the impairment. So the time that we are doing the impairment is 31 December. We are looking for present value. So it should be from next year. If you are given a cash flow from this year, please ignore. The value in use should always be the present value of the future cash flows, which will be starting from 2023, 2024, 2025, up to that number of years that you are given. And the cash flow should always be a pre-tax cash flow. Okay, the cash flow should always be a pre-tax cash flow. Why should it be a pre-tax cash flow? Because your discount factor will also be a pre-tax what? Discount. Okay, so the cash flow should be a pre-tax cash flow. Your discount factor should also be a pre-tax what? Discount rate. So these are the cash flows. They are going to be for only 3 years. And we also look at the discount factor, which will be what? Which will be 12%. So let's now find the value in use by that one. So value in use, we can use the normal discounting. So we have value in use. Value in use will give us, then you have the 2023. You can use it year 1, year 2, year 3. There's no problem. So we have the years here. So we have the years. We have the cash flow. We have the discount factor of 12%. And we have the present value. So the years you can state 2023, 2024, 2025. Okay. What are we having for? What is the cash flow for each of them?
23, 185.
185, okay.
160, 24.
Okay.
130, 25.
Okay. So if you like, you can name them year 1, year 2. We are doing this at the end of December. So December 2023 is 1 year from now. So 12%. What will be the discount factor? The first year, 12%. 1 over, that will give us 1 over 1.12 exponent 1. 2020.
0.893.
0.893. Okay. 2024 will be 1 over 1.12.
797.
0.797. Yeah. Okay. 2025 will be 3 years from now. That will be 1.12.
0.712.
0.712. Okay. Let's multiply. What are we having? I'm having 165.21 for the first one.
Yeah.
Okay, 165.21. Okay, the second one will be
127.52.
Okay, 127.52. Okay, and the last year will give us
92.56.
okay 92.56. What will be the total value?
56.8858.
Okay, this one is 56. Sorry. Okay, 56.
385.29.
385.29. So this is the value in use. The present value of the future cash flow is value in use. Please, can we calculate net realizable value based on what is given to us? Can we calculate net realizable value from the question? Look at the last one, the footnote. The goodwill does not have a market value. It is estimated that the land and building could be sold at 270 million, and the plants and machinery could be sold for 50 million net of direct selling cost. So what is the net realizable value? If we want to sell, how much are you going to be selling the
320.
Okay, so that will be 320. So those are the net realizable value for you. So you have your land and building. Land and building will be how much? How much are we selling it?
270.
Okay, 270. And plant and machinery will be what?
50.
Okay, that will be 60. So plant and machinery will be 60.
50.
All right.
50.
So the total amount will be what?
320.
Okay, which of these is higher?
Value in use.
So we pick the value in use as a recoverable amount. So our impairment will now be calculated as our impairment loss will now be calculated as 500 minus what? 385.29. Is that correct? Is that correct?
114.71.
Okay. So they say we should calculate the impairments. Calculate the impairments. What is the question? Calculate the impairment loss to be recognized in the account of these people. So that is the impairment loss. Explain how the impairment loss will be accounted for. That is what we are coming to do. How do we share the impairments?
So the
goodwill will take first.
So the goodwill will take, and the other one will be in proportion.
Okay, so we have the distribution of the impairment. Distribution of the impairment loss. Okay, goodwill will be taking how much?
70.
Okay, goodwill will be taking 70. We have goodwill will be taking 70. So if goodwill is taking 70, how much will be left?
4.71.
Okay, so the amount that will be left will be
44.71.
Okay, 44.71. Okay, that is something that I will be showing you something over here, which is also important. Okay, let's come to the plant and machinery. Land and building, what is their net realizable value? It's 270, isn't it?
Yeah.
Okay, and this one is 320. Okay, if you count the plant and machinery, it's also 50, but this thing is what? 110. Sometimes they will give you they can give you this figure. You see, this is 110, isn't it? Plant and machinery is 110, the carrying value. The question can give you their net realizable value to be 117. What will happen is that you cannot reduce the carrying value of the asset beyond its net realizable value. So the impairment that will be given to them will be only, okay, this will be 107. You cannot reduce the carrying value of the asset beyond or below its net realizable value. So the 110 over here, the impairment that we are going to be giving to them will be 3. The maximum amount should be 3. So you can take the 3 and then share the remaining one to what? To a building. But what is happening over here is that they are all having a net realizable value below their carrying value by higher margin. So let's just share this thing to them. So we have land and building will be, so this will be.
Explain that again.
Okay, I'm saying that you cannot reduce a carrying value of the asset with an impairment below net realizable value. Okay, so if you come here, we have plant and machinery. Okay, the plant and machinery, the question can give us a net realizable value of 104. Let's share this. Let's share this particular one. Let's share the impairment loss based on their own proportion. That will be 320 divided by the total. That will be 320 plus 110. I'm having 430.
430.
So we have 430. 430 divided, I say 430. 320 divided by 430. Multiplied by the remaining impairment loss. 44.
71.
Okay.
71.
What are we going to be getting for that?
33.27.
Okay. 33.27. You don't have to do this one. Just find a difference. 44.71 minus 33.27. How much are we getting?
11.44.
11.44. And that will give us 11.4.71. And I'm saying that supposing they are giving you, the question was giving you a net realizable value of 107 relating to plant and machinery. You can see that the share of the impairment loss, plant and machinery is taking how much? 11.44, isn't it? Plant and machinery is taking 11.44. But what they are saying currently is that the plant and machinery can be disposed for what? 107. Their net realizable value is 107. So we cannot reduce the carrying value of the asset below their net realizable value. So what we can do is that, okay, this is 110. The net realizable value is 107. It means that this has impaired by only 3. So we charge only 3 to the plant and machinery, but the remaining impairment will be taken to the land and building, because their value, which is 320 against this one is 270. It has reduced by 50. So the impairment of the remaining amount can be given to them. So you don't have to reduce the carrying value of the asset by an impairment loss below the net realizable value of the asset. Okay. They are telling you that if you go to the market, you sell the asset 107. So it means that the current value of the asset is 107. You cannot reduce it more than that particular amount. So you always pay attention to the net realizable value. You can't reduce the value of the asset below its current net realizable value. But here is the case, their net realizable value are all lower than their carrying value by a higher margin. So we share it to them. Okay, how do we recognize this? Land and building, there is existing what? There is existing revaluation surplus on their account, isn't it? Land and building are carried at revaluation. The surplus relating to the revaluation of the land and building that remain in the revaluation surplus reserve as at 31 December 2022 is 65 million. Whenever there is an impairment loss on a revalued asset, the impairment loss is treated as a revaluation loss. So the impairment loss of goodwill is taken to profit or loss. So goodwill will be taken to profit or loss. So this is how we do the impairment. Profit or loss. Profit or loss. We are going to be having impairment of the goodwill and then the plant and machinery. That will be 70 plus 11.44. Okay, so that will be 81.44 as statement. But if you go to other comprehensive income, the land and building, we'll use that now to cancel the existing revaluation that is on the account. So that will come here as 33.27 because they are having a revaluation of 65. So impairment loss relating to a revalued amount will be treated as a revaluation loss relating to a revalued asset. So impairment will be taken to the other comprehensive income to cancel the portion of the revaluation surplus that is on that particular asset. So basically, this is what they are asking you to do. This is the basic impairment for corporate reporting. This is the basic one. Okay, this is the basic one. What will be the advanced one? It will be the corporate asset. They can still bring the corporate asset. Let's be going and see if we can tackle that question before we, please, today is not the last day. We still come on.
Hello, sir.
Yes, yeah.
Yes. So can we conclude that before you distribute the impairment loss, you must compare the net realizable values to the carrying amount?
Value. Yes, please. Yes, please. Okay. So, yes, you are writing the exam in the afternoon, isn't it?
Yes, please.
So can we meet at a Monday dawn? If we are not coming to learn, I will just come. How do you, question one, how do you go about it? Maybe we can address certain issues, maybe the standards. If you see the question, at least 2 hours or 3 hours, maybe 4 to 6 or 4 to 7 before you go and sleep until by 1 p.m. you go to the exam hall.
It will help. It will help. It will help.
It will help us a lot.
Okay.
No problem, Kenyan.
All right.
Let's do it that way.
Okay, but let's finish this one. Let's finish this one now. Okay, please. This is how your you see. First, it was case study. That was a difficult paper. Now case study is the easiest one. They are making the coup. I don't know whether it is the Institute of England and Wales. I don't know whether they are the ones setting the corporate reporting question. I don't know because it's right now it's not easy for the past 1 year. The corporate reporting has always been at a different level. I don't know how they are doing it, but let's see. This is how the any special question that you have been seeing for corporate reporting will no longer be like that. It will now be like this with plenty adjustment and a lot of issues. Let's see what we can do about let's see what we can do about this one. Question number 5, any special. Auntie Agnes, you are not there. Okay, she's not there.
If she's not there, I'll read. Okay.
Okay. Yeah, Auntie Deb, can you help us?
Answer.
Yeah. Yeah. Someone wanted to read, so we are in your hands. Yeah.
Question 5.
Okay, so yeah.
The LAR Limited's equity balances as at 1st October 2020 comprise the following, amount in 1,000 Ghana cedis. Ordinary share capital, 10 cedis per value, 20,000. 10% irredeemable preference share capital, 10 cedis per value, 8,000. Share premium, 2,500. Revaluation surplus, 1,500. Retained earnings, 25,700. Shareholders fund, 57,700. The trading results of the companies were as follows. We have year ended 30th September 2022, and then year ended 30th September 2021, amounting to 1,000 Ghana cedis. Profit for the year after tax 2022 was 3,612, 2021 3,146. Additional information. A. On 1st January 2022, the company issued 400,000 ordinary shares at full market value. Oh.
I think we have lost.
Yeah, the network is worrying everybody. It's not easy. Yeah, Senator Chris.
I can now get it.
Okay, okay.
The additional information, I've read it.
Okay.
Then the C, on 1st December 2021, D Limited invited its ordinary holders for a right issue in the proportion of 1/4 at 12 cedis per share. The shares were quoted immediately before right issue at 15 cedis per share. All the rights were fully subscribed. D, the company has had in issue a convertible loan stock of 6 Ghana cedis million, which carries an effective interest rate of 8% per annum. Each 1,000 cedis nominal value of the loan stock will be convertible at the holder's option into 600 ordinary shares. On 1st June 2022, holders of 1.5 million share, 1.5 million loan stock exercise their conversion option. E, the income tax rate applicable to D Limited is 30%. F, the company declared and paid dividends. Yeah, the company declared and paid dividends on both classes of the equity shares required. Basic earning per share for the year ended 30th September 2021 and 30th September 2022. Diluted earning per share for the year ended 30th September 2022.
All right, thank you, Senior. It should be calculate, but maybe I have omitted and calculate. Okay. So we are doing this for 2021 and what 2022. So please, you have to know that the earnings per share is only calculated for equity shares. Okay. But we have 10% redeemable preference shares. Irredeemable preference shares, since they are not going to be redeemed, since we don't have an obligation to pay them any cash on a particular day, they are also treated as if they are equity shares. So their dividend is treated in a normal way that the equity shares will be treated. So if you want to find the profit attributable to the ordinary shareholders, you always subtract the irredeemable preference shares. But for redeemable preference shares, they are treated as a financial liability under financial instruments. So we send that one to profit or loss already. So it's only the irredeemable preference shares that you are going to be subtracting from the profit for the year after tax. So we have to determine our profit attributable to the ordinary shareholders for each of them one by one. Then we now come to our weighted average number of shares. Okay, so let's tackle that. So let's come to the basic earnings per share is calculated as profit attributable to the ordinary shareholders. Profit attributable to the ordinary shareholders. So ordinary shareholders divided by our weighted average number of shares under a consideration, under the year of consideration. So we have the weighted average number of what? Of shares. Okay. So that will be that. So let's find the profit attributable to the profit attributable profits attributable to the ordinary shareholders. Please, if you are, they can ask you to calculate the earnings per share for a parent company. You always use the profit. We use the parent shares. So what is the earnings per share for that? So we use the profit attributable to the parent, not other comprehensive income. Revaluation supposed to not be profit attributable, but this is just a normal one. So you come here and you have 2021. So let's do for the 2 years at once so that we are not going to be having problems. So let's have 2022 and 2021. Okay, what is their respective profit after tax? Okay, we have 2022, 3612, 3612, and we have 31. I'm sure that will be 46. Okay. So what we do now is that we subtract irredeemable preference dividends. So let's count the dividends for the irredeemable. Okay, that will be irredeemable preference dividend. That has not been taken away from the profits. So how do we calculate that? We have to look at the so that will be calculated as the percentage attached to their shares multiplied by the share value. That would be
I think that way 800, right?
okay.
8 million.
Okay. So they have 8 million. So 10% on the 8 million. So we are paying 10% on the value. So that will be 800, I'm sure.
800.
Okay.
Yeah.
So we take the 800 from this, 800 from this. What are we having for 2022? I'm having
2812.
Okay. And 3146 minus 800.
812.
Okay.
2346.
2346. Okay. What we have to calculate now is the weighted average number of shares for 2021. Okay, we have to do it for 2021 first and 2022. Okay, let's come here. Okay, I have so many ways of calculating this, so you just have to be with me. Okay, at the start of the year, what is the number of shares that they have in issue?
$400,000.
Okay. How are you getting the 400,000? No, the 400,000.
That's 2,000 shares.
Okay, that will be 2,000 shares. At the start of the year, our ordinary share capital
2,000.
is 8,000 at 10 cedi. Okay.
20,000, yes, 20,000.
It's
That is a value.
2,000.
20,000 is a value. Okay.
Divided by 10.
2,000.
Okay, that will be 2,000, isn't it? Okay. So we have 2,000. So we have existing shares. Existing shares. That will be 2,000. Okay, we have 2,000. That shares will do 1 year, isn't it? They are being from at the beginning to what? To the end of the year. But let's come to during the year. The end of this year will be this financial reporting period will be 1st October to what? To 30th September 2021. That is the first year, isn't it? Okay.
Yes.
On 1st January 2021, the company issued 400,000 ordinary shares at full market what? Value. Okay, the company issued 400,000 shares at a full market value. So the full market value will have effect from 1st April. So let's have the full market issue. Okay, the full market issue. I will show all the possible ways that you can calculate this. That will be, so this will be, we are keeping 3 zeros for this one. So this will be 2 million.
400.
So do we do it 2 million, or we should do it only 400 for this?
400.
Okay.
Just hang the zeros like they've done it already.
So we add the zeros, isn't it?
No, let's carry it. Let's carry it.
Okay. So that will be 400 here. Okay. Let's come to, so from January to the end of the year, how many months will this particular share do?
12 months.
Are you sure? January
To September.
Yeah.
That should be 9 months.
Okay, that should be 9 months, isn't it? If
Yes.
there are no additional issue of shares, the shares at the beginning of the year will contribute a full year to the profit. So we can divide it by what? By the profit. But this one will do only 9 months. So we multiply by 9. But let's look at what is happening here. Okay. On 1st April 2021, the company made a 1-for-5 bonus issue of ordinary shares to the existing shareholders utilizing its retained earnings. When are we doing the bonus issue?
At the beginning of April.
Okay. Bonus issue are assumed to be in existence from what? From the start of.
From the start.
First, yeah. The start.
So it means that this 1-for-2 is going to be affecting what? The ordinary share capital of 2,000, isn't it?
Yes.
Okay. The same time to be affecting the full market value that was there before, isn't it?
Yeah.
Okay. Let's do this calculation. If we are doing 1-for-5, bring 5 existing shares for 1 new. So that will be 1/5 multiplied by 2,000. How many shares are we going to be giving?
200.
Okay, that will be 200. Okay.
4.
That will be 400. Okay.
Yes.
It means that the bonus issue is going to be affecting, we have to add 400 to these people. Is that correct?
Okay.
Okay, we have to add 400. But what we normally do is that we use the bonus fraction. So the bonus fraction will be 6/5 for this one. You'll be getting 2,400. Is that correct?
Yeah, 2,400.
All right, let me take that again. Okay, I will show you all the possible ways of doing it. You pick the one that you want. Okay, the bonus issue is assumed to be in existence from the time that the company has been incorporated. Okay, so if you are doing the bonus issue, what is the bonus issue? It is 1-for-5. So the 1-for-5 will be on existing shares that we have. So these shares will also increase by 1-for-5, 1 out of 5. We are going to be increasing this year by 1-for-5. So if these shares are 2,000 and we are giving a bonus of 1-for-5, that will give us 400. So they will get a bonus of 400 in addition to they are already 2,000 that they have. That will give us 2,400. Okay, and these shares will be there from October to September. They are going to be having a full year impact on the profit. So you can prorate by 12/12. It will be there for full year. So that will have a full year impact on the profit. But let's count to the 400 that we are issuing. These shares were there before the bonus issue. So they will also be taking the bonus issue. So this will be 1/5 multiplied by 400. What are we getting as a bonus issue?
80.
That will be 80. So it means that the 400 shares will also be getting 80 bonus, isn't it?
Yeah.
Okay, but these shares will be there for how many? These shares have been there for how many months for this current year?
9.
They have contributed to the profit for only 9 months. So you prorate by 9/12. So it depends on what you have to do. You can multiply this by the bonus fraction, and this will have 12 months contribution. You multiply this by 6/5 to get your 480, and this will be there for 9 months, which will be 9/12. Let's come and see whether.
Senior.
Yes, please.
Senior, So in a situation whereby you don't bring the 6/5 and you bring the 400, or is it a mistake or?
No, you just add the 400 to it and put it in a bucket, multiply by 12/12. There is no problem.
Okay.
Okay. And this one too, you can also do this place. You can do 400 plus 80, then into bracket, all multiplied by 9/12. There is no problem with that one also. Okay. Let's see whether there was any other issue. Were there any other issue in the current year, which is October?
The Linus,
Yes, please. I'm with you.
the first ordinary share of 2,000, the
Yeah.
time fraction you use is 12/12.
Yes, please.
But I'm thinking it should be from October 2020 to the January 2021, when the full market issue was.
Okay. Okay. We have so many ways of killing a cat, and that is the second. That is the
I
second.
don't understand the 12/12.
Okay. The 12,000, the 20,000. You understand the 2,000, isn't it? You understand the 2,000? Are you there? Is she gone?
Yes, please.
Okay.
Yes, please.
Assuming no shares have been issued, what will be your share at the end of the year?
Oh.
Assuming there was no issue during the year, what will be your number of shares at the end of this year? 30th
No
September. Assuming no shares has been issued.
The 2,000.
Okay. So it means that the 2,000 will be there for a full year, isn't it?
Yes, please.
So if you want to prorata, it will be 2,000 multiplied by 12/12. It will be a full year, isn't it?
Yes, please.
Okay. So what I'm doing is that the existing shares will be there for a full year. Okay. So I'm not going to touch that. So that will do a full year contribution. So if there's a bonus issue, the bonus issue will also do a full year. So that is 12/12. Then I will count now to the full market value. What will be the bonus element on the market value? That will be 80. And this 80 together with the 400 will be doing 9 months. So I'll multiply that. What you are saying is another way of doing it. That is a complicated one. I will still come and show that one also as an alternative way of calculating the weighted average number of shares. What are we getting for this? This will be 2,400. Okay. This will give us what? 480 multiplied by 9/12. I'm getting 360. Is that right?
Yes, please. 360 is correct.
Okay.
Correct.
So let's use our alternative one. Okay. Alternative one, which I normally see to be some way, but let's look at this. Okay. Before the market value, which was on 1st January, the existing shares are going to be doing 3 months, isn't it?
Yes.
Okay. So that will be multiplied by that. So the bonus fraction will affect this 6/5 multiplied by 3/12. Is that correct?
Yes.
So that would be from October to January. So let's write October
Yes, please.
to January. Okay, now you are saying yes, because this is what you have. Okay, let's count to January to April before the right issue.
April.
Okay, we'll be having 2,400, which is the existing shares plus what? Plus the new issue.
The new issue.
The bonus fraction will also affect this. Okay, and this will do how many months?
January to February, 4 months.
Okay, are you sure? It will also be 3. January to
Three.
April is 3. So that will also do.
Wait, January to March.
Okay. So after
Okay,
this one,
2020.
this will now be April to what? So let me do January to March so that you will not be confused, isn't it? Should I do January to March, or let me just write the April here? The April is at the beginning. Okay, so April to September will be 6 months, isn't it? Would that be 6 months?
Yes.
Okay, so what would be the total number of shares after the rights issue? It will be 1/5, 6/5 multiplied by the 2,400. I'm getting 2880. Okay, the shares after the bonus issue will be our 2,000, which will be having a bonus issue of 400 and a market value at a bonus issue of 80. Would that be 2880?
So,
Yes, please.
please, the share issue, the ordinary shares.
Yeah.
I'm not talking about the weighted one.
Okay.
The beginning was 2,000.
Okay.
And we have a new issue of 400.
Yes, please.
What of the bonus? You didn't add the bonus to it.
Now the bonus the bonus is the one that we are doing at 6/5. 6/5 is the one giving us the bonus.
Oh, okay. Okay, so you are now calculating that one.
Yes, please. So let's come here. This will give us 2880. How do we get a 2880? There will be a bonus issue on the existing one of 2,000, and there will be a bonus issue of 80. So that will be 2,000 plus the bonus issue plus the new issue of 400 plus the bonus issue on that. Or you can do the 2,400 multiplied by 6/5. That will give you 2880, and this will now do 6 months. If you will add, you'll be getting the same figure as 2760. Okay, but I normally find this one to be too complicated. But anyhow that you understand it, there's no problem with that. So 2,400 multiplied by 3/12, I'm getting 600.
This one is the FM one.
Okay, so let's have 2880 multiplied by 3/12. I'm having 720. And I'll have 2880 multiplied by 6/12. I'm having 1440 plus 720 plus 600. You have your 2760. So any of them, but I normally find the second one to be too complex. But any of them that you are comfortable with, we are okay. Okay. Our basic earnings per share will be 2021 will be our profit of 2812 divided by the number of shares of 2760. What are we having?
Manos.
What you are doing is rather 2022.
Manos.
Yes, yeah.
There's a right issue.
The right issue is in the second year, 2022.
Oh, okay, I'll tell you.
So this will be 2346. Okay.
I get confused with this method.
Which one?
The FM method. I mostly get confused on that.
So pick the one that you are comfortable with. Okay. For
So
me,
with this one,
yeah.
The normal one that we were doing.
Yeah.
So the bonus would have been 400.
Okay. The bonus would have been
Then
400. Okay.
sure.
Okay.
So that would be
okay. Let me also bring this one down for you and see whether if you can get this one. You know that existing shares will be 2,400, including the bonus issue, isn't it?
including the
Bonus
new
issue. The bonus issue, no. October to January, including the bonus issue, will be 2,400. bonus issue will be 400 on the existing one, isn't it?
Ah, sir, please do. The
Yes.
starting one was 2,000.
There is a bonus issue. The bonus issue affects it. Bonus issue is assumed to be in existence. It should be an issue from the start of the year or the start that the company or the time that the company start operating.
Okay.
So it doesn't matter
Okay,
when
but
it
I
is
brought,
given.
okay.
Okay. So the bonus issue on 2,000 will be 2,400, isn't it? Okay.
Yes, please.
That will work. That will be in existence from October to January before the new issue. So you can multiply this by 3/12. Okay. If there is the new issue will be 2,000. Okay, that will be 2,400. The new issue will be 400 plus the 2,000, give us 2,400, and there's a bonus issue of 400 already. Okay. And the bonus issue of the new issue will also be 80. So at this date, we are going to be having 2,880, including the bonus issue on all of them, because the bonus issue was done on April, which is going to affect the shares at the beginning of the year, which is 2,000. Bonus issue will be 400. The shares issue at the beginning of January will be 400. Bonus issue on it will be what? Will be 80. So from January to April, there will be a shares of 2,280. That will also be done for what? Will done for 3 months. Then from the time that the bonus issue is done, our 2,880 now will do 6 months. This is too complicated. Okay. Just ignore here. Okay, start from here. You can see that January to September, your shares will do 9 months here. So that January to September, your shares will do 9 months here, 9/12. So you can get everything, then you'll still be getting your 2,760. So you'll be getting you'll be getting your 2,160 here. If you add a 2, you'll be getting 2,760. Okay. Which is the same as,
Yeah, Brian,
yeah,
do you know what? My challenge is with the 80 that you added.
now the 80 will be on the 400.
Because what I learned from the other lecturer was, sorry for taking you back.
Don't worry. We are together.
After the first issue and we brought the bonus,
Yeah.
for him, what he did was he brought the January 1st one.
Okay.
Then he brought the bonus fraction on the 400, the January issue one.
Okay, that will
Then
be
he
80.
brought is there?
The bonus issue on the 400 will be 80.
Yes, and he brought the 400, which is the bonus, and that one it was throughout 12 months. Do you get it?
The
So
400, okay, so the bonus, he brought 2,000 over here, multiplied by 12/12, isn't it?
yes,
Okay. Then you are going to be having 480 here. 480, which is the market value plus the bonus issue itself, which will be 9/12, isn't it?
okay.
Okay. Then we now have the October to September will be the bonus issue on the first one, which will be 400 multiplied by 12/12. Is that correct? Okay, let me expand this one for you. This will be 400 multiplied by 6/5 multiplied by 9/12. Is that correct?
Yes, that is what he did.
Okay. The 6
Then
over
we had the
5 multiplied by the 6/5 multiplied by 400 is the same as 480.
Yes, that was the weight.
Okay. Okay. This is the same as what we have done for the first one. You can add a 400 to this one. The 400 is on this one, which is 400 plus this will be 2,400, 12/12. Then you now bring this one as this particular one. There's no problem with that. You will still be getting the 2,760. Anyhow, you go
Yes,
about
the reason why I was pressing on this is because when you are going to the next year
Yeah.
to start with a new issue,
Yeah.
then it means you have to add the 2,000, the 400, the 400 down before you get the total shares to the next year.
Our shares in the next year will be 2880, which will be 2,000 plus the bonus issue of 400 on the 2,000 plus the new issue of 400 plus the bonus issue on the 400, which is 80, 2880.
That is on the way.
Yes, please.
On the way.
Yeah. So going to the next year, you don't have a problem with that. You just have to ask yourself, what was the shares in issue 2,000? What was the bonus issue on it? That is 400. So that will be 2,400. There was a new issue of 400 that will also be added. What is the bonus element on that? That is also 80. So your total shares will be the 200, the 2,000 plus the 400 bonus issue on it, plus the 400 which has been new issue, plus a bonus issue of 80 that is on the new issue of 400. So that will still be 2880. Okay, so going to the next year will not be a problem at all. All right. Thank you very much. But just stick to the one that works for you. There's no problem. Okay. There is no cause for alarm. All right. What will be our earnings per share for the first year? We do it to the what? To the highest denominator. So multiply by 100. If it is 0 point something, change it to pesos. So we have 85 pesos per share. Are we okay with that? Are we okay with that?
Yes, please.
Okay.
Yes, sir.
Okay. Let's move on now. 10. We have 30 minutes. Okay. Let's see if we can do another 2 standby before we move on. Okay, so we are done with the first one. Okay. Let's come to on 31 December. This will be in 2022 year, because the 2022 year will start from 1st October to 30th, 1st October 2021 to 30th September 2022. Bonus issue. This right issue is related to that. But what will happen is that let's ask ourselves, at the start of the current year, which is October 2021, what is the total number of shares that we have? What is the total?
1,880.
Okay. The total number of shares will be our total number of shares will be 2880. Okay. How do we get a 2880? That will be 2,000 shares. Okay. That will be plus the 400 plus the bonus issue of 400 plus the 80 bonus issue on the 400. That will give us 2880. Okay. So let's now find our weighted average number of shares. Okay. So let's have the existing shares. This is what you are going to be doing. The existing shares will be 2880. So we look at how do we do the issues of the right issue. Okay. The right issue was done on 1st December 2021. The right issue will always have a full market value together with what? With the bonus issue. So how do we determine the full market value and also the bonus issue? We do what we call theoretical, we calculate what we call a theoretical X-right price. So let's calculate the theoretical X-right price, which is the value of the shares after the right issue. Okay, so what we do is that we calculate this by we always use the unit method. So the existing shares, okay, how many of the existing shares are we bringing from for a right? We are bringing 4. The right is the 1. The number of shares that you are bringing from the right is the 4. So 1 4, the 1 for 4. So a right is 4, and you are bringing 4 shares for a right. Okay. So the existing shares will always be the last one. So 1 for 4. These shares are trading at how much?
12 cedis per
No.
share.
The 12 cedi is
And
the right issue. Okay. So the 12 cedi is the offer price, which is the right issue price. So if you weight this particular one, we are getting 60, isn't it? Okay.
Yes.
So the right issue, you are given a right of 1 cedi at what? 12, isn't it?
No.
Okay.
Yes.
How much are we getting? That will give us 12, isn't
12.
it? Okay. So this will give us 72.
72.
And the number of shares will be what?
5.
Will be 5. So what will be our theoretical XY price? That will be, so 5 shares are at 72. So how much will be a share? 72 divided
14.4.
14.4.
Okay, 14.4.
14.4.
Okay. These shares, the shares are supposed to be issued at what? 14.4, isn't it?
Yeah.
But these are issued at how much? Okay. So the full market value, this is what you are going to be doing. I will show you all the possible ways. Then you pick the one that you want. The full market value is 12. Okay. So our bonus issue price will be what? Would that be 2.4? The actual price should have been 14.4. But this shares has been sold to the people at what? 12 cedis. That is the market value. It means that we are giving 2.4 to them as what? As a bonus issue. Okay. What will be the total number of shares from the right issue? The right issue will be on the bonus, will be on the existing shares. That will be 1 over 4. So 1 over 4 multiplied by 2880.
70.
7 what?
20.
Okay. So this 720 should be issued at what? 14.4. Okay. So this 720 should be issued at 14.4. But the full market value is 12. The bonus issue is 2.4. So we can share this one by saying 2.4 over 14.4 multiplied by 720. That is a bonus element. 12 over 14.4 multiplied by 720. That will be the right issue element. So what are we getting? Let's do it like that and move on to 2.4 divided by 14.4 multiplied by 720. I'm getting 120.
120.
Okay. Bonus issue is
The
120.
first one is 600.
And the full market value is what? 600 shares.
600.
Okay. So I will do, look at this. The bonus issue will be added to this one. Okay. And there will do 12 over 12 because these are existing shares. Okay. How do you also get a bonus issue? This is what you are going to be doing. So you can add the 120 over here. We'll be getting 3,000, isn't it? Okay. This can also be calculated by you doing what we call the right issue fraction. How do we calculate the right issue fraction? The right issue fraction is calculated as a cumulative price, which is the price immediately the right issue divided by theoretical XY price. Okay, that will give us 15 divided by 14.4. Is that correct?
Yes.
Okay, so you can come here and multiply this your figure by 14, 15 over 14.4. You should be getting 3,000.
Senior,
Yes, please.
with the 120 before full year.
Is it? Yeah, it's a full year. It's a bonus issue. So it doesn't matter when it is being issued. Okay. Right issue will come with a bonus issue and full market value. So it's only the full market value, which is 600, that you are going to pro rata from 1st December to the end of the year. That is a full market value. The bonus issue, it doesn't matter when it is being issued. It will have effect on the what? On existing shares, like see if it has been with the existing shares. Please, if you multiply this, what are we getting?
8,000.
Okay. So you can also multiply this first and have multiply 15 over 14.4. We have 3,000.
Senior,
Yes, please.
was it that in last year, 2021, we didn't charge the 9/12 on only the 400, but we added the 80.
The 80 is a bonus issue. So the bonus issue will have effect from the time that particular shares were in existence. So the shares were in existence from 1st January. So the bonus issue also have effect from the January on the 400. Are you okay? Those people were not there from the beginning. They were there from what? January, isn't it?
Yes.
So the bonus will be given to them from January. So from January to the end of the year, they will have only 9 months contribution. So that's why we multiply the 480 by 9/12. Okay. You can see that 6/5. If you multiply, you get 480. So if you like, you can add the 80 and do multiply by 9/12. That's no problem. Okay. All right. What was the share before we are having 3,000 here? The shares at the beginning of the year was 2,880, but we are now having 3,000. Okay. So the shares has increased by how much?
120.
Okay. The 120 reflects the bonus issue portion. Your right issue is 720. If 120 is a bonus issue, what will be the full market value? That will be 600, isn't it?
Yes.
And that will be from December to the end of what? October. Okay. How many months is that? 1st December to October. How many months is that?
10 months.
Is it 10? Okay. That will be 10 months. So December to October, that will be 10 months. So we have 600, which is the full market value from the bonus issue. We multiply by 10/12. Don't worry, I will show. Okay. So that will do only 10 months, which is the full market value. The one that they are paying money for is 600. That will have a contribution of 10 months to our profits. Let's be moving on and be reading. So that's how you treat the right issue. Let's come to another side over here.
Hello, Senior.
Yes, please.
Yeah, please. The December, are we counting from the 1st December or the 31st December?
We are counting from 1st December. The shares were issued on 1st December.
Then I think it will be 11 months.
No.
It's 10.
We start from October. The year starts from 1st October.
Yes, yes.
The end of the year is 30th September every year. So it will start from 1st October. So 1st October, that's 1 month. Then November will be another 1 month. Then we now have December to be 9 months. Okay.
Okay. All
right.
Thank you.
The company has had an issue a convertible loan stock of 6 million, which carries an effective interest rate of 8% per annum. This is for diluted earnings per share. Each 1,000 nominal value of the loan stock will be convertible at the holder's option into what? 600 ordinary shares. Okay. On 1st June 2022, holders of 1.5 million loan stock exercise their what? Their conversion option. If they exercise their conversion option, it means that they are now converting to what? Equity shares. When are they converting to equity shares? From what date?
1st June.
Okay. So from 1st June to 30th September, how many months is that?
4 months.
Okay. Okay. The question now is, how many shares are they converting now to? You can see that the value is 1.5 million. Okay. Their value is 1.5 million. So let's now come there. Their value is 1.5 million. Okay. Their value is 1.5 million, which is the loan stock. That will be 1.5 million. So changing it to a full amount will be what? 1,500,000, isn't it? Okay.
Yes.
Each 1,000 of this amount, how many shares are they giving?
600.
They are giving what? 600. So what you do is you can divide this by 1,000 and multiply by 600. Or you can do 600 over 1,000 multiply by 1,500. Since we are keeping 3 zeros, how much are you getting?
900.
You'll be getting 900. Okay. Okay, we are going to be, so if they are converting, they will be getting 900 shares. They are saying that every thousand of the nominal value, their nominal value is 1.5. So we'll just bring every thousand from the 1.5 and get a share of 600 for the 1,000 that you are bringing. So the question is, how many thousand can we bring from 1.5 million? So that would be 1,500 divided by 1,000. We are going to bring in 1.5. Then the 1.5 multiplied by the number of shares that we are bringing from every 1,000 for this one. That will give us 900. So they will be giving 900 shares. So that will have effect from June to what? September. June to September is how many months?
Four months.
Okay. June, July, August, September. That will be 4 months. So 4 over 12 multiplied by 900. What are we getting? I'm getting 300 for them. Is that correct?
It's correct.
Okay. 600 multiplied by 10 over 12. I'm getting 500. Okay. We also try the alternative way of doing this one. Okay. The alternative way is that you keep on applying the bonus issue up to the time that the bonus issue is done. Okay. So what we do is we will now have the first, we keep on applying the bonus issue fraction until, so we have the existing shares over here. So we have the existing shares over here to be 2880 multiplied by 15 over 14.4 multiplied by, so this will be done, the bonus issue. We are be applying the bonus issue up to the time that the bonus issue is done. So that will give us 14.4 multiplied by 2 over 12 because October to December is 2 months. So we do 2 over 12. Then we now ask ourselves, okay, from December to October, that will be 10 months. So what will be the number of shares there? The number of shares will now be the 2880 plus the bonus issue of how much? Of the right issue fraction rather. Right issue will be 720. Would the right issue be 720? Would the right issue be 720? 1 for 4.
Yes, sir.
That would be 720. So what will be the total number of shares? The 280 that we have plus the right issue of 720. Okay, and this year's will do 10 months, isn't it? Okay, then we count to June to September, which is a conversion. That will do 900 multiplied by the 4 over 12. So we have 300 here. 3,600 multiplied by 10 over 12. What are we having? I'm having 3,000. Okay. And the first year will give us what? 500. The first one. Okay. So this will give us 500 rather. This will give us 3,000. So we have the 3,000 here. You have to be getting your 3,800. Okay. It depends on how you understand it. There is no one way of doing this one. So for me, this is what I normally do. I try to find the bonus fraction from the bonus. The right issue will always come with the bonus elements and the full market value. The full market value will have effect from the time that the issue is done. But the bonus issue will just have effect on shares that has been there before the bonus issue. So I try to separate the bonus issue from the full market value. So what are the shares there before the bonus issue? I'll find that one and add it to the existing shares. How many months effect are they going to be having to the profit? How many months are they going to be contributing to the profit? The 2880 will be there from the beginning of the year to the end. They are having a full year contribution to the profit. So the bonus issue will be on them from the start of the year. So I'll just add a 120 to that to get my 3,000. Okay. My market value from the bonus issue is now 600. How many months contribution will it do? It will have effect from the time that the bonus issue is done to the end of the year. That will be having 10 months contribution. So I will be getting a figure over there. Then I will come to the shares, the convertible stock that has been converted into what?
Sir,
Shares. That will also be having 300. Yes, please.
you've been saying bonus issue, bonus. Is it not right issue, right fraction rather?
Yeah, they are all called we are using the right fraction to know the bonus elements. So we can still call it a bonus fraction.
Because I'm thinking that the right fraction will be on the from the new issue and the beginning 1, 2.
Okay. So we have
the way we
we have included all of them. The new issue and those ones, they are all going to be having a 12 years effect now. Those that we issue to them, they are going to be with us from the start of this year to the end of the year again. So they are going to be having a full year. So you can include it on the existing shares. That will not have any problem with that. If you also want to separate it, there is no problem with that one also. All right. Okay. So our weighted average number of shares for 2022 will be our 3,800. So let's find the earnings per share for them. The basic earnings per share will be 2022 will be 28.12 divided by 3,800. How much are we getting?
74 pesos.
Okay, so that will be 74 pesos. Okay, so that is the basic earnings per share. They are asking us to find weighted average number of what? Number of shares. Okay, I say weighted average, diluted earnings per share. Okay, the diluted earnings per share is that, okay, what are the instruments that are available now that are going to be having effect on our shares in the future? So if those instruments should be converted, what would be the effect that will be having on our shares in the future? That's what we are looking for. That's what we are looking for. So let's count to that will always be on the convertible instrument. So that will be our profit attributable to the earnings multiplied by the notional interest or the notional savings divided by our weighted average number of shares plus our notional number of shares. Okay. And this will be the only two items that will affect this one is the share options and also the convertible instrument. And the problem that we have over here, our own is the convertible what? Instruments. It is a convertible what? Instruments. Okay, let's come here. We have the convertible instrument of 6 million in issue, isn't it?
Yep.
Okay, but 1.5 has been what?
Has been converted.
Okay, so what will be the value of the convertible instrument in issue now at the end of this year?
The value?
Yeah.
4.5.
Okay, that will be 4.5. So that will be 4.5 million. So we have the convertible instrument now will be 4.5. Okay, 4.5. Value will now be 4.5 because it was 6. They have converted 1.5. So that will be 4.5. Okay, this 4.5. What was the interest that was paid on them? The interest was how much? We are paying interest at what?
8%.
Okay, so what is the interest that we are paying? So we find the
0.36 million.
Okay, so the interest will be 0.08 multiplied by, can we make it 4,500?
So 360.
Okay, that will be 360. Assuming these people, this interest will be, we are going to be allowed to subtract this interest from profit before the charge tax, isn't it? Okay, so currently it means that we are having a tax savings we are having a tax benefit of what? 30% on these amounts, because whenever the tax authority will allow us to subtract the interest before we charge tax. So it's currently there's a tax benefit of what? 30 on this one. What is the tax benefit there? 30% on that. What will be your tax benefit?
90.
That will be
108.
108.
okay. I'm having 108. Okay. If these people they are converting the instrument into equity shares, we are going to be saving what? Interest of 360, isn't it? If they are converting into what? Into equity shares, we are not going to pay them the interest again, isn't it?
It is.
So we are going to be saving interest of what? 360, but we are going to be losing a tax benefit of what?
108.
So what is the net amount? What will be the net benefit?
That should be 252.
Okay. So the interest that you are going to be saving will always be, the interest saving will always be after tax interest savings. And that is how we calculate it. That will be, if you are paying tax of 30%, if you are now retaining this, it means that you are going to be losing a tax benefit. So you only be retaining only 70% of the 360. And that will give you
252.
Okay, that will give us 252. So we'll be having interest savings of 252. So we count to our current profits. Let's count to our current profit now. That will be 2812. So we still have 2028, we have 2812. Then we add our 252 to it. Our current weighted average number of shares is 3,800 because we are doing this for 2022. If we are converting this into equity shares, how many shares are we going to be having? So we need to calculate our number of shares. So our number of shares will be 4,500 divided by 1,000 multiplied by the 600 that we are having. What will be the number of shares that we are going to be having?
2,700.
Okay, 2,700 multiplied by 600. Okay. Okay, sometimes you can check whether the instrument is dilutive. How do we check? We look at the interest that we have divided by 2,700. So let's check that first before we go ahead. Let's check whether the instrument will be dilutive. So 252 divided by 2,700. I'm getting 0.09. Would that be 0.09? Okay. Which
Yes,
is
0.9.
9.3.
Yes.
So this one is having 9.3. But what is our current earnings per share for 2022? It's 74, isn't it?
Yes.
Okay. As soon as you do this particular test, you divide your interest. You divide your interest by the number of shares that they are getting. And the answer that you are getting is lower than the current earnings per share. It means that these instruments are going to be causing a dilute, or they are going to be diluting your earnings per share. The situation where you have 80 over here, which is higher than the 74 pesos, it means that this instrument has no effect on the earnings per share. So we call it anti-dilutive instrument. But this one is going to be diluting this. So we include it in calculating our dilutive earnings per share, or the diluted earnings per share. So the top is 2812 plus 252 divided by, so I'm having 3064 divided by 6,500. Okay. So
47 pesos.
okay, so 47 pesos. So it means that if these are converted in the future, they are going to be having effect on our earnings per share. Okay, or if these are to be converted now, they are going to be reducing our earnings per share from 74 pesos to 47 pesos. That is what we call the dilutive earnings per share. Please, you really have to pay attention to this one. The earnings per share should not have a problem. No, you shouldn't have a problem with it. Okay. If you are giving me 500 6 months to the end of the year, if I made a profit, you only have 6 months share of the profit. You can't be fighting with me to have a full year. That is how the earnings per share works. Okay. Yeah, Auntie Juliet. Auntie Juliet, your hand is up.
Yeah, good evening, sir.
Yes, ma'am.
Please, the convertible bond was converted on 1st June 2022.
Yes, please.
And so what about the interest for the 8 months before the 1st June?
The interest for the first month, we have paid that. So they are not part of the people that we are going to be converting. So the interest for that has been captured in our profit for the year. So that will not be interest service because they are not, we are not going to be having any interest service. If there is an interest service also, we have paid interest of what? Interest of 8 months. That has been taken into our profit or loss account before we have this. And this will have been they have converted on 1st June. That will be 4 months to the end of the year. That particular interest service is already included in our profit or loss because this happened during the year. So they have done everything concerning this one. Okay. So we have accounted for everything already. And the 4 months, we didn't pay interest. So that interest was not taken from our profits. So the interest savings has been captured in the profit already. Okay. So that has been captured. So forget about the conversion that has been done. The only thing that we'll be looking for is the number of shares that we'll be getting. Whatever relating to the interest for that first 8 months, the people, they were still convertible holders. So we have paid the interest of 8 months to them. After the 8 months they have converted, we are not paying interest. And the interest was not taken from profit. So that interest savings is already part of the profit there. Are you okay? All right.
Okay, thank you, sir.
So let me look at the number of questions that we have again. Yes, please.
Yeah, hello.
Yes, yeah.
Yes. So I don't know how you came about that.
Is that?
We can't hear you. We can't hear a question.
Senior, we can't hear you, Senior. Can you WhatsApp me after the class? Okay. So seniors, it's 10:34. I have FR class at 3:30 a.m. So I'll try to solve the remaining one, share the solution with you, and we see. Okay. So yes, as we have agreed, Saturday, say Saturday, Monday dawn, that will be in the evening. I will communicate that, and we still look at that. Please look at. We have solved this question before. Employees benefit. What is that question? There is a question on employees benefit here. Please, you can revise it again. We have solved this one in class, so you can still revise it. This one. The following information relate to. So you can look at this one. We have solved it. Where there is an issue of, you might be seeing employees benefits in the exam, and anything can happen. So we can. This is about financial instruments. I would love us to solve a question on financial instruments, but I'll solve it, share with you, and we will talk during the class. Also revise impairment of a subsidiary. We have solved one question on that when we are doing that. We have done a question. We have done the joint arrangement and the segmental analysis. I'll solve one question under I've solved a question. There's a video that we solve a question on the impairment of subsidiary. So please, let's try to look at that. I'll try, although the time is not there, but I'll try to solve this one. This question too, the time that we are doing our intangibles, I've explained this one, the players acquisition. So That one. This is a change of plan for non-current asset head for sale. So you can try that one too, but I will try to solve them, share with you before that. The employees benefits. This is also financial instruments. I will try to solve them and share them with you. Please, I said I will share them. So if I'm done, I will share. Don't give me pressure because I don't like pressure. So that is yes. So Sines, it has been a very nice opportunity for all of us, and it was very nice having all of you guys. And I will say thank you for the support, for the understanding, for the cooperation from day one up to now. We are finishing, but we are not finishing for life. We will still meet, we will still talk. Whatever be the case, do your own revision. Don't go and be looking for questions that this. No, the possibility that you are going to be seeing questions before going to the exam hall is 2%. And the probability of you not getting it is 98%. So don't go and be looking for information because you see a question, you don't know what to do, and you are frustrated. Please, whatever will come, it will be within the syllabus. Make sure that you have 80% control over whatever is in the syllabus there. If you see the question, don't just jump on the question. Please read, understand, use your 15 minutes very well. Don't go there and be doing anything. No, look for a 50 marks. Where can you get a 50 marks? Manage your time very well. If you have a question on the standard and you don't know how to do the calculation, please, if you can understand the standard or if you can identify the standard on which the question has been set, please write what you know about the standard. Okay, if the question is on financial instruments and it is about impairment of financial assets, and maybe you cannot calculate, what do you know about financial assets under impairment when we are talking about financial instruments? Just explain something there. There's always a 2 marks question for maybe the explanation or identification of the standard. Write the English before we start with the calculation. Okay, that is, I will still share the corporate reporting master scheme with you, and you see how it ticks and how some of the questions are always answered. Please, this is yes, this is all that I can say.
We are concluding.
And this is all that I can say for now. I wish you all the best. May the good Lord be with you. And let's see what will happen after July. All right. Thank you all.
Thank you. God bless you.
All right,
Thank you, and God bless you so much.
all right,
Thank you, and God bless you. We are
Right.
grateful.
all right, now.
Yeah.